Good morning, Armor Insiders. Welcome to the morning meeting of our virtual hedge fund. Thank you guys for joining me today. It's Friday, end of week. Welcome all of our guests. I've opened up this live stream. We're going to go all day from this live stream. So I've opened it up for all of our friends to join us. Anybody who wants to be part of this desk today, I'm here to share information with all of you. We have been risk off on this desk since February 21st, which is basically the top of the market. So I'm going to go over why we've been like that and what we think's happening, where we're going from here. Happy to answer any questions. So feel free to share this link with whomever you think could benefit from the information. Before I dive in, and we'll go over our swing trading strategy, our day trading strategy in volatile markets, what the non-farm payroll number means to me, and how we're going to be positioning going forward. Before I go through all of that with you, please remember this is a virtual hedge fund desk. What does that mean? I ran hedge funds for a decade. I've been running private capital for 35 years. So what I do with this trading desk and what I share with you every day is the strategy and approach of how institutions run money. And the single biggest thing that separates institutions from an individual investor is risk management. So I called this experience the ARMR report. ARMR investing stands for Algorithmic Risk Management Research. So we begin and end with risk management. Everybody out there is going to talk about the next hot stock. Get on this, the stock might double. They're all carnival barkers, and they all get buried periodically in markets like this. What we're trying to do on this desk is manage real money we've worked real hard to accumulate. And as my dad always said to me, if you don't respect money, it will find its rightful owner. And that's what bear markets are. If you haven't respected your capital, it gets ripped away from you. And so what we do on this desk, look, hedge funds have entire departments dedicated to risk management. What we do on this desk is we have a department dedicated to risk management. It's called our risk monitor. That risk monitor looks at and has algos created for the volatility of 10 assets, 9 indexes, and Bitcoin. And when all 10 of these assets start to march in the same direction, there's only one animal that can make that happen. And that's the elephant. That's the whale of the institution. Institutions don't put money to work today and then take it out tomorrow. They're managing billions of dollars. They have to make longer term decisions. So when they begin to stampede in a certain direction, it happens for a while. And so our risk monitor is very simple. It sniffs out that directional move that's going to last for a while. Let's call it swing trading. A while being a series of months, weeks and months. We reflect that in our macro fund. We call it our macro fund. We swing trade indexes in the macro fund. And the risk monitor drives that. And of course, 8 out of 10 stocks follow the market. So when it comes to buying individual stocks, market doesn't care whether or not you love an idea. Market will run roughshod right over all your favorite ideas if the elephants are stampeding in a different direction. So what we do is first we figure out where the elephants are going. Then we figure out, do we want to build out our portfolio of investments? So I'm going to walk you through what this year looks like to me and what we think our base case scenario is of where we're going. Before I do it, I respectfully request you grab a pen and a piece of paper so you can jot some of this down. I request that you consider yourself a hedge fund manager on a desk. It's a virtual hedge fund desk. Don't come to this with other thoughts on your mind. Be focused and say, look, I'm a hedge fund manager. I'm managing my own assets. That's the tranche of capital you have. Figure out your risk tolerance and your goal, and then execute that strategy. I'm going to share with you my strategy. That doesn't mean it's right for you. This is not, quote, investment advice. How could it be? I don't know who you are. How could it possibly be investment advice? I don't know what your portfolio looks like. I don't know what your risk tolerance is. Only you know that. So I'm going to share with you the experience of how I run capital for myself and for others. And then I'm asking you, take this seriously. Consider yourself a portfolio manager. How does the information affect what you're thinking? What's your risk tolerance? What are the goals for the capital you're running? And then execute that strategy and be the smart money. You can't count on me or other guys that you hear to tell you what to do with your capital. But you can collect valuable information and then make money with it. On this desk, we like to say, information makes money and institutions make markets. So let's get to the risk monitor. Let's get to our risk monitor. We traded all the way up last year. Risk monitor greens all the way up last year in this nice uptrending channel. You're looking at now the S&P, just a simple SPY, okay? All these green boxes, the risk monitor went green, 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 okay? And then right here, and we'll just load it up like that. Right here, which is the 21st of February, off of that double top, the risk monitor went red. And we've been red ever since. What happens when we go risk monitor red on this desk? We start playing defense. We raise a lot of cash. Right now, we're sitting in roughly 70% treasury bills for our flagship fund. So when I share with you this information throughout the trading day today, there's two different ways to look at this. I share with you what I do personally. So I'll talk about my carry trading portfolio, my macro fund, and my investment funds. And then I try to put that together in a package, and I call that the ARMR flagship fund. So I run my own personal capital, and then I run capital for others. The flagship fund reflects what I'm doing for the capital I'm managing for others. That fund is about 70% cash. Treasury bills at 4.3% is a choice. When that risk monitor goes red, that's an investment decision to hold treasury bills. And we've had a large exposure to treasury bills since the risk monitor went red on the 21st of February. And as you can see, that's right near the highs of the year. In fact, the all-time high in the market right now. It's important that I explain the risk monitor is not about understanding the fundamentals at the moment. It's not about me saying to you on the 21st, hey, I know that there's going to be a Trump tariff tank and we should get out of the market right now. Oftentimes, when the risk monitor goes red, everything looks great. Everything looks great. Institutions are moving out. But to you and I, the individual, it looks great. What do the institutions know that we don't know? Institutions make markets. Information makes money. The simple fact is institutions running billions of dollars pay for information. Don't hate the player. You can hate the game if you want, but that would be like howling at the moon. It's the way the stock market works. Don't hate it. Understand it and benefit from it. If institutions pay to get information ahead of time and they start moving, I don't care what the information is. If they start moving, I know I have to adjust my risk. I'll find out later what the reasons are. There's two reasons right now. The first reason, and I shared this with you in a video on this YouTube channel. You can go back and look at it. I just posted it on X. And please feel free to share this link right now with whomever you think could benefit from these conversations throughout the day today, because we're going to go all day. And you can go ahead and follow me on X, and you'll get these updates. I shared with you on the 3rd of March. Risk Monitor went red on the 21st. I shared that with you on the YouTube channel as well. But then I shared with you on the 3rd of March my roadmap for what's happening right now in the market. And what I said to you then is that this year looks remarkably like 2000, 2001 to me. Let me show you what I mean. Okay. This is the market on the left of the screen. You're seeing March 2000, the year 2000, March market top, commonly referred to as the dot-com bubble that burst. Okay. This was a 40% collapse from the high to the low in 2 months, March to April, April to May. Those 2 months, March 24th to May 24th, NASDAQ dropped 40%. I'm telling you, I think we're in that exact same cycle now. This has nothing to do with tariffs. This got started because the AI excitement, as usually happens in the market, went way over its skis, right? And now it's tumbling down the slope. It happens all the time. It happened. You might not have been around during the dot-com bubble burst. I got into business professionally in 1992, 93. Okay. So I was there, made a lot of money in 1999 and had a huge, I think our portfolios back in 2000, March of the first quarter, we were up like 33% in the first 3 months. Bang, the market collapsed. We were using stops at the time. I didn't have a risk monitor, but we had stops. We got banged out of our whole portfolio at the end of March. I was like looking around trying to figure out, I was a relatively new guy on the street. I was like, what just happened to my portfolio? Got stopped out of everything. At the end of 2 months, market was down 40%. I was like, thank God I got stopped out of everything. That was probably the kernel, the germ of what started the risk monitor for me. Okay. But I digress. So where are we today? If the NASDAQ follows the same bubble bursting process, right? We had this great new technology called the internet. Believe it or not, I was around before the internet. Scary thought. Okay. And you had companies coming out, zero revenue, zero earnings, all futuristic stuff, burning through cash, coming public, people throwing money at them. The famous sock puppet, right? Millions of dollars spent at the Super Bowl that year for pets.com, which of course was bankrupt a year later. Okay. Fast forward to today. AI revolution, everything's great. Companies coming public with no earnings, no revenue, no hope of revenue, raising tons of cash. They'll be bankrupt in a year. It's the same story. You know, history doesn't repeat, but it rhymes. Does the market have to drop 40% in 2 months? No. Who knows? Who knows? But I hear people arguing this point with me, and it's the same chirping in the ear that I heard in 2000 and 2001. The market cycles repeat. I think AI is wonderful. I think it's going to lead to massive industrial change, just like the internet did. But there's going to be a serious period of retrenching, and it started on the 21st of February when the risk monitor went red. Then I shared with you another video a few days later, maybe a week later. Again, you can find it on my YouTube channel. Just a 3-minute video. And some of you, a lot of you found it. I've got 15,000 views on it, so I appreciate that support. In that video, that 3-minute video, I shared with you a watershed event where the CEO of Microsoft came out and said, we love AI, but we don't see any return on investment. There's no killer app for it. We're spending tons of money to build out data centers to work on ChatGPT, chatbots. Great for the consumer, does nothing for our bottom line except for suck cash. And we're backing away. Backing away from data centers, backing away from leases. Same thing as the year 2000. But in the year 2000, I can't remember a CEO of a major technology corporation right at the top coming out and telling the world that the AI revolution, the time the internet revolution, was something to back away from. I don't remember that. Satya Nadella, he was so kind to come out and make that comment. I was shocked when I read it. He loves the technology, but there's no ROI, and he's backing away from data centers and walking away from leases. And you still have chuckleheads on CNBC talking about how great the internet is, the AI revolution is. The risk monitor went red. Got to protect capital. Institutions saw exactly what he was saying, and they've been running for the hills. It's because we're in the year 2000 again. If it follows the year 2000, 2001, so this is my discussion for what's coming next. What are we going to have next? Man, you have to have wicked patience, grueling patience, mind-numbing patience. There will be some face-melting rallies. You'll think this is the beginning of something big, and it won't be. It's going to take time to digest all the overreach of AI and set up the next cycle. Now, here's the fun thing. Coming out of this bear market, we should be able to make some generational investments. So it starts with risk management. So you're not one of the people holding the bag as the market's collapsing. Nobody on this trading desk is holding the bag. Well, I'll tell you what bag we're holding, a ton of cash. We're holding a bag of US Treasury bills as the market's imploding. And coming out of this, just like .com, coming out of this, in 2002, Facebook came public. Google came public. After the collapse, Google came public, Facebook came public. And of course, some of the companies that were involved in the collapse skyrocketed. There's going to be some unbelievable AI investments that you and I are going to scoop up cheap. But it doesn't happen in a week. If we go look at the roadmap of 2000, 2001, we're in the midst of the crash, the crash. Then there'll be some type of a bounce. In 2000, there was a 3-month bounce in the summer that set up the bear market, the real bear market, from September 2000 to September 2001. And the only thing that got us out of that bear market, unfortunately, was a terror attack that brought the Fed in. But let's not predict a terror attack, and we don't know when the Fed will come in. Who knows? History rhymes, it doesn't repeat. But the purpose of telling you that, terror attack, that's not the purpose. It's that the Fed started to liquefy the market. Hey, here's another question. Not question. Here's another layering on reasons for why this market is melting down. Take a look at this. You guys can find this yourself on the Fed's website. Total assets. Fed's total assets since the beginning of the year. I'm going to blow it up for you. Since the beginning of the year, look at the Fed's assets. They're going straight down since the beginning of the year. And you're wondering why the market's imploded? It's a very simple equation. Markets go up when the Fed's adding liquidity. Markets go down when the Fed's reducing liquidity. And it's right on the Fed's website. This is what's been happening to Fed liquidity. Those are the assets. Okay? Those are the assets. So we have a combination of factors. AI overreach that has to retrench, just like .com. Fed assets, Fed sucking liquidity out of the market. That leads to bear markets every single time. And now let's layer on the insanity of the Trump tariff tank. What the market's telling you right now is that it totally is underestimating the man running this country. I truly believe this is not a political discussion, first of all, okay? I'm happy to tell you my politics if you want to know. I don't mind. I'm a Republican. I like Trump, voted for him, okay? I'm not wild MAGA. I would say I'm somewhere right of center, and I try to support what I think is reasonable and right. There's right and wrong. I like to support what's correct. Okay? So this is not a discussion about politics. I think myself and a lot of people like me in the investment world have a baseline opinion of Trump. A lot of us think that Trump is the guy who wrote the book Art of the Deal. And we elected the guy who wrote the book Art of the Deal. The market tanked yesterday and is tanking again today because I think there's a mistake we're making. The Trump that wrote the book Art of the Deal died on a stage in Pennsylvania. And the man who woke up the next day believes he's been touched by the divine, has a mandate to create real change in this country, and is going to do that. Doesn't make a difference what people think. This is not about art of a deal. It's about executing something he believes in. And that's going to create unreal uncertainty in the stock market. You know, the stock market's a voting machine. That's all it is. It's a voting machine. And what happened yesterday and today is that a lot of institutions, me, you, a lot of investors were expecting one thing from the tariff. You know, usually what politicians do, the market's been selling off for 6 weeks leading up to tariff day, right? And usually what politicians do is seed the market participants with information so that when the news comes out, it's not traumatic. And what you usually get is selling on the rumor and buying on the news. So the rumor is tariffs, and everyone's afraid of that. The market's been selling off. And then you have tariff day, and the news is not as bad as people expected, and the market has a relief rally. You know what I'm talking about. It happens all the time. What happened yesterday what was a shocker to institutions alike. The market was trying to put in a double bottom, starting to move higher. When he started speaking, the market was up in the aftermarket. And then he pulled out that board that showed all of the tariffs, and the market reversed and started tanking. People were caught off guard. They think they're dealing with a guy who wrote the book Art of the Deal, but they're not. So the Trump tariff tank is now like an accelerant that's been dropped on top of 2000, 2001 retrench off of the AI bubble burst. Non-farm payroll number. I don't care, non-farm payroll number. Let's don't spend a second talking about it breathlessly, that it was better than expected, blah, blah, blah. It means nothing. And if you go back and look, early in the year, you usually get better than expected non-farm payroll numbers having to do with birth, death models and all this other baloney that they mess with the numbers. And then later in the year, the numbers get revised lower. So caring about non-farm payroll every month is a bit of a joke. It's just not, it's not worth my time talking about. Okay. There's a lag, things that are being done now. It's a waste of time. But if you want to take it from the standpoint of, will the Fed add liquidity sooner rather than later? If you're looking at non-farm payroll and the numbers are a lot better than expected, I think unemployment went up a bit, right? But payroll numbers were higher than expected. So it puts the Fed in a bit of a bind. You know, if you start getting negative job growth and unemployment spiking up, maybe the Fed's going to come in. If you get muddled numbers, and then you have tariff issues and prices are going up, it's the hands of the Fed. The Fed can't add liquidity. The Fed's been sucking liquidity out all year. Anybody thinks the Fed put is out there? It's not out there right now. They're not going to turn around and start adding liquidity. Not here. Not at these prices. Not if there's inflation off of tariff wars. Particularly not if there's inflation, but there's no major jump in unemployment. Like, why would they do it? So you have this vortex right now of a wicked bear market. There's going to be great day trading opportunities. Volatility has gone through the roof. I'll be doing that all day. That's the only thing I'm doing on the desk. So if you're going to spend all day with me on the desk, all I'm going to be talking about is this a shot to get long the S&P? I'm trading double the S&P. Usually I trade triple the S&P for day trading purposes, but I won't trade a triple in a market like this. The spreads are getting too wide. The bid and offer is getting crazy on SPXL. So I'm only trading SSO, and I don't want the massive risk of triple. When volatility goes berserk, I can have smaller position sizes and have huge days. We have to manage the risk on these days if we're going to take a trade. So we'll be using our day trading playbook to get long the market starting at 9:30. You're all welcome to join. I'm here to answer questions all day. You got questions, you want to throw them up, let me know. The one issue I've got that I might want to add to the portfolio again is going to be treasury bonds. Let's look at treasury bonds again. I toyed with TLT inside of this area, you know, made a little bit of money, then it reversed. I got out, it looked like it was breaking down. Now it's skyrocketed this week, okay? But let's not be too worried about the prices in and amongst here. What we're really looking for is a break of this downtrend. So you're looking at TLT now on a daily chart, okay? This is the downtrend going back to 2020, okay? And we're breaking that right now. If treasury bonds close above 93 today, we're 93.88 right now. The treasury bonds, 20+ year bonds will be trading above the 200-day moving averages, all the moving averages, and above the downtrend. So I can tell you with a fair amount of certainty that if treasuries close above 93 today, I am going to have a treasury bond position in my portfolio again. I don't need to hedge right now because we got 70% treasury bills. So there's not much hedging I need to do. Okay. We have some precious metals exposure, about 15% of the flagship fund. We have some dividend stock exposure, utilities, tobacco, telecom, and some pipelines. The pipelines are getting hammered right now, which makes absolutely no sense. I'm not touching that part of the portfolio. They're just annihilating oil, right? What the tariff tantrum is that we're going to have global recession. So you're getting base metals, any materials that are required for expansion during a recession, there'll be less. So oil's down 7% today, natural gas down 5% today. I'm going to keep collecting my dividend yield and my pipelines. I have the right allocation there, and I can deal with the swings. And quite frankly, one of the first places I'll go to increase my exposure in the dividend fund is more pipelines. If they're going to, I need more cowbell. You know, in this case, it can be more pipelines. If they actually whack the pipelines, that'll be great. Pipelines have been trading like this. Whack the pipelines, the yield goes up, and you know, natural gas, domestically produced natural gas going through pipelines is going wonderful business. So if they actually kill it right now, I'm looking to increase that size. So we got 15% more or less in dividend producing stocks, which are down. Some of them are down today. It looks like utilities are up a bit. I've got about 15% in precious metals, which is down right now a little bit. And remember, I've said to you guys, when the market's imploding, they get to everything. So I've got about 30% invested, 70% cash. So maybe TLT, treasury bonds, if they're getting to everything, treasury bonds are going to go up. So that might be a good counterbalance for the other part of the portfolio where I still have some investments and I don't want to disturb them. So that's our exposure right now. You guys have any questions? I'm happy to answer it. Got a few minutes before the market opens. Let's take a look. Jay's asking, is SOXL a good buy here? After everything I've said, Jay, I'm going to let you answer that question yourself. After everything I've just said, do you think triple semiconductors is a good buy down here? I'm going to let you answer that. Okay. Jeremy, you're only holding TLT. Jeremy's saying, I'm only holding TLT. Thankfully. I wish I was more aggressive on the downside. Yes, Jeremy, it's right. It's not gamma, actually, Jeremy. You got alpha. So you're saying that what I say is you got alpha just by holding cash. It's not gamma, alpha. So alpha in your portfolio, alpha is your portfolio's performance versus the S&P. So if the S&P is down 5% and you're flat, you have massive alpha that day. And then what we want to do is try to harvest that alpha by getting focused on buying the S&P right. The first step now, and I'll just say this too. The first step now, if I build out long investments, is to get long the S&P. That's all the risk I need right now. If I'm going to get long anything, I'm going to day trade the S&P. And if I get on a ripper, I might hold that overnight and have S&P exposure, because I like to call it harvesting alpha. Market's down another 2% today, down 5% yesterday. And, you know, even if net worth is just flat, even if you're down 1%, the market's down 7%, you got a huge alpha. So first step is to harvest that alpha by owning some of the index itself, which is, let's be honest, a very conservative way to put money to work. No individual stock risk. We're not, the market goes up, but semiconductors keep going down. We're not trying to guess what group works. And in this tariff environment, trying to guess what group is going to be the beneficiary is very difficult. Okay. So all we have, let's simplify in this market. We've protected capital, market's crashing. All we need to do now is put some of that capital into the market as the market recovers and harvest the alpha of being defensive. Then once we've done that, we've earned the right to take more risk as the cycle starts to improve. But again, it's going to take time. This doesn't reverse overnight. People keep thinking we're in a bull market, and they keep thinking, oh, I don't want to miss the rally. What they should be thinking is, I don't want my capital attacked. I want to be patient. All right, Jay, what do you think about, okay, Jay, I don't want to stop you. You keep asking me about semiconductors. Go do whatever you want. I don't know where you're coming from. I'm talking about an investment portfolio. You want to try to day trade something? You could day trade anything. Okay. I personally have been talking about, my expectations on semis is that they unwind this entire move. That's my expectation. But I don't want to stop you from putting a trade on. Go ahead and do whatever you think's right. And you can see it's come right down to the original breakout, right? So semis are right down now at the original breakout and blowing below it. So they're going to open below that breakout, and you're going to open down near the 61.8% retrace of the entire AI bull market. Semis went through the roof because you needed semiconductors to build out data centers for AI. Then the CEO of Microsoft in here said, we're walking away from leases. We're walking away from data centers. We don't see any return on our investment. All this investment he made, we don't see any return on it. We're walking away from it. It's imploding. It's something, for some reason, you feel like that's something on your list to do. Go and do it, Jay. Don't let me get in your way, but I think you know my opinion. Yes, I do wear this. Yes, I do wear this shirt quite often, and proud of it. Dupe Shop is saying buying us. Thank you, Dupe. Yeah, buying semis here is not the Armor way. We don't like to buy falling knives. Thanks a lot, Dupe. I appreciate that. And again, this is not investment advice, and Dupe's not. Jay, look, I don't know what you're asking about. If you want to day trade it and maybe you catch a rip, I mean, do whatever you want. For me, I think we need to simplify, and if we're going to day trade, we need to focus on the index only, because you got to be protecting capital. The bottom can fall out of this market. I mean, I don't want to be hyperbolic here, but when you get into a bear market and you see the Fed draining liquidity, guys, I lived through the dot-com collapse. I lived through the financial crisis of 2008. And I don't think I feel a lot of you haven't lived through those things. And so you're used to a more engineered market where the Fed's always supporting and buy the fucking dip became like a meme. Okay. And respectfully, that's not the market we're in. Maybe I need to show you this again. Maybe this is something you need to see again. Okay. This is what's been going on the Fed's balance sheet since the start of the year. the Fed's draining liquidity out of the market, right? So please don't. I guess I'll just finish on this. You can trade whatever you want. I'm not giving you advice. Go do what you want. And anything for a couple days could rally. I mean, at any time. So I think we all are, adults here. We understand that. I'm just saying this is an incredibly dangerous market. I've been saying that from the 21st of February, which is the top of the year. Okay. And it's and so if we're going to put capital to work, do it in a manner that is conservative, which is the S&P. It's as conservative as you get. That's my approach. And then of course, feel free to do what you want. How do you go about shorting volatility or not? Any particular indicator? I don't trade volatility. I tried for a long time, a few years back, and I got to be honest with you. You got to play to your strengths. That's all any of us can do. And my strength is equity. My strength is not trading volatility. Some guy, the bell ringing, market's opening up down 2%. So some guys are great at trading volatility, and if they're great at it, via con dias. But it doesn't work for me. So I avoid volatility. Oh yeah, Jay says he asked before I said. Sorry, Jay. God, now I feel bad. I'm going through comments right now. So Jay said, yeah, he gets it. All right. At Skip, it sounds like a catch. Oh, yeah. Oh, Skip's asking about volatility. Yeah, I don't trade that. The answer to that question on Mush Ashin, not sure what your name is there, but I think your answer was great for Skip. I agree with that. Preserve cash and sit in bonds. Yeah, that's what I am. All right, guys. So markets open. Let's watch how markets trade. My focus today is adding a long position on TLT if it closes above 93. So I'll be looking at the day trading chart. So what we have here is the day trading chart is my 3-minute chart. So this is a 3-minute chart. Every bar, obviously 3 minutes, blue up, red down. All the lines on the chart are drawn by an algo we have called the Price Movement Profiler, the ARMR PMP. And the core of that engine is our VWAP. I call it ARMR VWAP, ARMR average true range highs and lows. I call it ARMR because I take off the shelf product. This is just TradeStation. So you can write code in TradeStation. So I take the VWAP code and we infuse top day and multi-day volatility components to come up with what we believe is a more effective VWAP. We have standard deviations 1 through 3 above and below it. We have an opening range, which is a 15-minute opening range. And off of that, we draw our Fibonacci extensions, 1, 2, 3, and 4 above and below. Okay, the black lines are just simple 1, 1.5, and 2% extensions from the opening range highs and lows. And then, of course, we have the ATR, which is really our one of our kind of our jewels. It's an average true range, but it incorporates volatility top day and multi-day. So the ATR moves up and down on our day trading screen, and it creates incredible entry opportunities and targets for where we want to book profits. Let's talk about Bitcoin. Someone's asking about Bitcoin. I am. Let's talk about Bitcoin. Okay. Anybody who knows me and knows this desk is I have a love-hate relationship with Bitcoin. Okay. So I want to tell you this so you know where I come from. So all the way up to 65,000. All right. I avoided it. And then I came out this was, I don't know, 2021, and I just pounded the table at 65,000 that Bitcoin was a disaster and you should be shorting it and getting rid of it. Okay. And it dropped below 20,000. Woo, I was right. Isn't that great? Isn't that great? Okay. Then I had a couple armrInsiders who are Bitcoin enthusiasts and have owned it from like, I don't know, 10,000. Okay. And they were telling me, God, Brett, please start buying some Bitcoin under 20,000. Did Brett do it? No, I was still in love with the fact that I called the top. All right. So then it blew out back to 65,000. We got the whole era of ETFs, and there was this debate going on. A lot of you want Bitcoin to replace gold. I'm a huge gold investor. Okay. I had a gold hedge fund. I've been investing in gold since 2005. We have large gold exposure. We're just killing it, right? I mean, gold's gone through the roof. We'll talk about that maybe later. But I submit to you, this whole time I've been saying to you two things. Number one, Bitcoin is not a gold substitute. It's a risk-on asset. And it's like risk-on steroids. And so whatever you're getting from, if the NASDAQ's going up, Bitcoin's skyrocketing. If the NASDAQ's going down, Bitcoin's collapsing. So that's not a store of value. That's just a risk-on asset. So we've been having that debate. But, okay, so fast forward to the election night. On election night, at around 8 o'clock on election night, you see that Trump's getting elected. And I did two things that night. I loaded up on Tesla and I loaded up on Bitcoin. And boom, exploded. Made some good money. That was a swing trade for me. Booked a profit, by the way, on both of those trades. Okay. So now you know my history. I'm not necessarily a lover of Bitcoin. It's a risk-on asset. I trade it sometimes. Okay. Now we have what's happening in the last 2 weeks has totally shocked me in a pleasant way. Maybe it is a store of value. Maybe you guys are right. Because the NASDAQ's imploding, the market's collapsing, and take a look at Bitcoin. I'm just using the ETF of ARK because it's, priced the same price as Bitcoin, right? But look, it's holding above the 200-day moving average. It's making a higher low. Then you go look at the NASDAQ's doing this, total implosion, and then you look at Bitcoin's doing that. So this, quite frankly, to me, and some Bitcoin buffs might argue with this and point out other times, but to me, this is the first time in the history of Bitcoin that it's actually storing value. It's not a risk-on asset. It's actually protecting assets. I'm shocked. I'm pleasantly surprised, and I'm this close to putting a Bitcoin position back in my portfolio right next to my gold position. By the way, one's not replacing the other. You would own both, okay? Gold has become a tier 1 asset, in case you're not up on the gold story, okay? Gold's become a tier 1 asset. We've been huge gold investors on this desk for a long time. But this parabolic move in physical, we own physical gold's our favorite way to do it. So Sprott physical gold. Okay? This parabolic move in gold has nothing to do with the fact that gold is the canary in the coal mine, and it's telling you something's wrong with the market. That's what they tell you on CNBC. It's ridiculous. It's got nothing to do with that. Up until a few years ago, banks were only allowed to hold government bonds on the balance sheet as a tier 1 asset or cash, right, to meet their capital requirements. And then gold became a tier 1 asset equal to government bonds, cash, to meet capital requirements. And that's been phased in over the last couple of years. Okay, we have huge debt problems in the world. Central banks have been hoarding gold for the last few years leading up to tier 1. This is why gold's doing this, and it's going to continue to do this. Okay, gold is a store of value, and it's going to help balance a lot of problems in the world. Okay, but for the first time, I mean, ever since I've been watching Bitcoin, it's doing something I'm a little shocked about. I can't believe it's trading here. I would expect it already to be down at the average price of MicroStrategy, which is 67,458. I thought it would be trading down by this dash line by now. And it may get there. I don't know. It may get there. But if it were to break this downtrend, boy, I'd be all over that. So I'm not a buyer yet. You know, I'm not a buyer yet, but I might join you guys. You're welcome. Happy to share with you guys. And so my question, I just read your question on, do I have any opinions on Bitcoin and main crypto? I only have an opinion on Bitcoin. I don't have any interest in the other crypto. Dennis, good morning. How you doing, man? Under 77,000, invalidation. I don't know what you mean there. I mean, if it takes out the lows, you know, it's already proving something to me that shocks me. So if it takes out the lows, I mean, we're in a wicked bear market. Look, man, I wouldn't say it invalidates anything if it goes down. In a wicked bear market, everything gets sold, even gold. Even gold gets sold. People just, they buy treasury bonds, treasury bills, and run for the hills is what they do. And so you get great opportunity out of that. You know, so if Bitcoin broke down, it wouldn't be a meaningful thing to me that would invalidate something. It would just be, it's a risk. It is a risk asset and it's going down, but the relative strength of Bitcoin is going up versus stocks, which is impressive. You know, that's my thought there. I love Newmont, but I nibbled away at Newmont yesterday. Okay, I didn't want to hold any leveraged funds, so I sold my nugget. Okay, I got out of my nugget up here. This is where I sold my nugget. I sold my nugget up here. Okay, and I rotated out of nugget because I don't want any leverage in this market, and I put some capital, but less capital, but I did put some capital into Newmont and Franco-Nevada and Wheaton Precious Metals and Royal Gold. And so I picked basically the three best royalty plays and Newmont, and that's my exposure to the mining space. But I'm going to be honest with you guys. If the market keeps imploding, they're going to kill these stocks. And I'm going to have to take them out of the portfolio again. They take out the low of yesterday. I'm taking them out. Okay. Utility stocks will come down. Tobacco stocks will come down. I mean, when there's a real flushing sound, nothing survives. And it's flushing right now, man. 5% yesterday, another 3% today. I guess that's kind of why I'm sharing this live stream with everybody right now. I think that it's I think it's important to express the dangers of the market. I was at my son's soccer practice last night and chatting with some of the dads. They know what I do, and so they were asking me some questions, and invariably they are, and I understand this. I don't fault them. They're complacent. They just, well, I'll just hold my position. I'll just hold it. I'll be okay. It'll come back. It'll come back. Okay, what's your time horizon? You're right. The market goes up 80% of the time, so the market will eventually come back. What's your time horizon for that comment is my question. Okay, what's your time horizon? Because if you're looking at this, okay, if you're looking at this, this is the bear market from 2000 through 2001. So we're up here somewhere. We're in this box. We're only here somewhere. We're somewhere here, probably somewhere here. Okay. So what's your time horizon? This is 2000. This is 2001. Let's do some fun math. I mean, it might not be too much fun, but I have this to 2000. Let's go to 2006, maybe. All right. How long did it take? Oh, so by 2006, the market still wasn't back at these highs. Okay. So 2000, and I've got guys telling me, I'm just going to hold my NVIDIA. I'm sure it'll come back. I'm sure it'll come back. Okay. So that's 2000. So 6 years later, the NASDAQ wasn't even close to those highs. I'm just giving you a reality check. Anybody who's, this is not investment advice. This is just how the market trades, right? This is just complacency gets built in over years of a bull market. I don't even know when did it come back. But this is 2012. Am I making my point? Is history going to repeat like that? I don't know. But you got to protect capital so you can live to fight another day. This was a lost decade for people after 2000. It's a lost decade. Or more than a decade. It's more than a decade. This is a reality check, guys. I decided to share this live stream with everybody just because I've been, I've been doing videos for you, and we have these morning meetings every morning. Okay, so every morning we have a morning meeting, and what I do for those of you who subscribe to the YouTube channel is I cut from that morning meeting what I think is interesting and maybe will be helpful. And I just felt like perhaps today we could have a chat. You can ask me whatever question you want, but also to I know it's, I mean, the market's just crashing right now, So, okay, so let's shift gears to Brett. I'm a guy who's caught. I was complacent. What do I do now? Which is what some of the dads were asking me last night. And if we go look at the year 2000, in the summer of 2000, okay, there was a rally. So this is a 40% collapse in 2 months. And then the market rallied back during the summer before it really started a grueling long-term bear market. So I would expect a rally back. And I guess my point would be, I'm not looking to buy the rallies. I'll trade them. But it's not a question of buying the rally. It's like when you get that rally back, recognize you're getting an opportunity to protect capital. That's what that rally, because when it rallies back, man, everyone on CNBC will be telling you tariff tantrum over, all the news is great, everything's okay. But these decisions that Trump has made, the art of the deal Trump died on a stage in Pennsylvania. Okay, and the man that woke up has been touched by the divine. That's what he thinks. And he's got a mandate, and he's going to do it. And this takes time to unfold. So that's just an accelerant on this collapse. But of course, there's going to be pieces of news that come out. Maybe Japan. Like, who's going to be the first country that decides to come out and cut a deal? My money's on Japan. There should be a Polymark, a betting, a service that allows us to bet on that. I would say Japan. Japan's going to come right out and figure out how to get rid of tariffs. The first country to do it's going to be the winner. They're going to get the best deal, right? Japan would be brilliant if they did it. So somebody's going to do that, and the market will rally on that. And what I submit to you is, instead of thinking that's the beginning of the next bull market, my thought will be, great, I'm going to make money on that swing trade. We're going to be long the S&P. We're going to harvest our alpha as best we can, right? We're going to do all that. And then I will be shorting the market for the next leg down. Dennis, the stop is the best thing you learned from me. Huh? I'm glad you were picking up what I'm laying down, brother. Let's take a look at our day trading charts here, because I'm looking for an excuse to get long the S&P. Jeez, man. I'll get to your questions in a second, but let's get to our trading charts. Okay, so again, this is our price movement profiler. This is all the bottom chart right here is the S&P. Every bar is 3 minutes. Up here, this is our 1 minute chart, and I just use that to help with execution once I get on a trade. Okay, so there's nothing to see there on the 1 minute chart right now. So I use the 3 minute chart to find my entry points and the 1 minute chart to help me execute. Okay, so what we've got right now on this chart that interests me, that looks interesting to me. Maybe I can blow it up for you. Okay, so again, every bar is 3 minutes here. So what we have right here is the average true range high. Okay, I'm going to just highlight it in darker. And the average true range low, which is right down here. It's a straight line. Okay, you'll see the high has come down. Okay, see that? So that the average true range high has come down, and it's collapsed on top of the opening range high and below the first fib up on the day. So this is a very tight trading range. In theory, the market's going to stay in that range. We know that's probably not going to happen today. Volatility is huge. So the best, what would I trade today? First of all, I want you to see here, this line right here, that line right there is the third standard deviation below the ARMR moving average, which is up here. Okay, so the third standard deviation below the ARMR moving average. That's what this is right here. So we're trading in an area normally. So when I'm carry trade, I call it carry trade. I have a portfolio where all I do is hold treasury bills. So I'm making money today doing nothing. Okay, and then the brokerage firm gives me full release on those bills to trade during the day. And they don't charge me margin interest. As long as I give the money back before the end of the day, it's a day trade, no margin interest. So I get to use my treasury bills, collect my interest, and trade on it. That's why I call it the carry trade. It's not the real carry trade, but that's the ARMR carry trade. Okay, I'm carrying treasury bills, collecting yield. We have to own the treasury bills for this to work, because if you have money in a money market fund and you day trade, people don't know this, but if you have money in a money market fund and you day trade, brokerage firm won't give you the interest because it doesn't settle. It takes 1 day to settle. So every time you trade, it doesn't settle in the money market fund, and so they don't feel they have to give you the interest. So if you're a day trader, this is very important. No matter what you're day trading, if you have a portfolio and all you do is day trade, you need to own treasury bills. So you get your 4% interest throughout 12 months. If you have a day trading portfolio set up, you have to own treasury bills. And at the end of the year, you're going to make 4%. And then you're trying to stack chips on top of that. But if you own money markets, the brokerage firm's stealing from you. They're getting your cash and not paying you interest. Okay, so we own the treasury bills. So we have a playbook of how we like to trade, and I call it a day trading playbook. Okay. The difficulty of trading right now, what makes it hard for me to trade today, is that there's nothing in the playbook about markets that are collapsing. That playbook is made out of normal volatility. So bell curve of volatility, and our playbook is in the fat part of the bell curve, right? And we're on tails. We're on the tail right now. So it's much more difficult to trade today. We're also below the third standard deviation, below that moving average. You guys who've been trading with me for a long time know that that third standard deviation line has been a money location for us. We make a lot of money down there. Getting long there for the rip back to the ARMR moving average. Cratering below it is problematic to me. It's like we're in the tail part of risk. And so while I want to trade today, I feel it may be better for all of us if we don't trade today. I'll be honest with you. So I'm looking for an entry point. But boys, it's going to have to be compelling because we are outside the realm of what our strategy is built on. You have to know what strategy you're executing. And when markets are different, we can still execute today, but we'd have to change our execution a little bit. Example, we can't buy big up bars expecting it to rip. There's too much risk there. The volatility is insane. Tail risk is insane. So what we'd have to do instead is try to buy really only what I like to call powder kegs. Tight. So wild volatility, and then all of a sudden it gets quiet, tight around a key location. When it pops above that powder keg, put a trade on early. You can't wait for the end of the bar because the end of the bar can be massive. So tight powder kegs I'm looking for. 15 to 30 minute tights after wild volatility on a key location. So what would be the first place for me to look? The ARMR ATR low of the day. Okay. If there's going to be a rally, that's been the location that's really been working for us. I'll give you an example. We did this yesterday off of here. Okay. Right here yesterday. So market gapped down and cratered. And you can't see it because the fourth Fibonacci is on top of the ATR, so it's red. But the fourth Fibonacci down from the opening range low and the ATR low were the same yesterday. And so then you got this tight formation, wild volatility down to the ATR, tight formation, lots of tails, but the body is all same price. And that the fuse is that yellow bar. That yellow bar popped above the high of that tight. That's where you get long for the only long trade of the day yesterday. So that's kind of the trade that I'm looking for today. Get down to the ATR, get wicked tight, or it could be a different location, by the way. I mean, sometimes Chicago Dave, throws out locations that are gamma locations. So maybe you'll share with that what the gammas are today, Dave. So he says 520 60. I wonder how does that line up with our charts? 520 60. Okay, so let's move one of our. So that's the VWAP today. More or less our VWAP is where the gamma is. So that's right here. Boy, we're right here. And it's a pretty good looking setup, isn't it? Geez, I almost want to get long. That's right. I mean, we're right on it right now, and this would be the bar to buy. 59. This is the 10 o'clock bar. That would be worth it right there, Dave. What do you think? Are you playing that? Position size is the key today, guys. Position size. Yeah, that's where, so it's just a question of position size. I'd like to see that the candle close. It's got to be a big up candle, you know, not big up. It just has to be, for me, it has to be in the top of its range. The top, let's say 3/4 of the range. If it's below that, I won't do this. So if it's a big tail and it closes down, this won't be the bar for me. That's not the bar for me. Mm-hmm. No. All right, so there's no trade. There's no trade right there. You see that? See how that was a tail? So we're looking at the 3-minute bar. It was a nice consolidation. It was the right location. It tried to break out, closed below. Not only was it not in the top 3/4 of the range, it was below half. So there's no trade there. You can't put that trade on. And so now it's going to go below it. And, you know, my location for the first trade of the day is going to be down here at the ATR. Now, you might ask, why would we bother trading today? And it's not a bad question to ask. I would say because the upside could be enormous. That's why. So it's worth putting a trade on here or there. I'm only using double, not triple, and I'm using smaller position sizes so I can take a shot here or there and see if I can get on some type of a monster move. So that's what we're hunting. We're hunting that monster move today. I don't know if we're going to get it. I mean, it's a let's talk about let's talk about the more bullish picture for a second on a Friday. You know, during this decline over the last 7 weeks, if the week has been a terrible week, generally Friday has been a recovery day. And it's a simple reason of people own puts. They're making a lot of money on puts, you know, and they generally don't want to hold it over the weekend because puts decay faster than calls. And so they generally book their profits. And so you get those 0-dated, 1 week option guys that sell their puts some point today. They sell their puts to book their profit. When they sell their puts, the market maker's buying the put and turns around and buys the underlying asset. And that's why the market has these levitating moves on a Friday after a bad week. So a lot of traders like us are looking for that move today. Problem is the tariff tank does it get in the way of that? Are people willing to carry the K over the weekend because who knows what the next story is? And the market's imploding. Who wants to hold anything? Don't people want to hold their puts? Blah, blah, blah. Protect profits. Although those guys who are trading they're probably just long puts. But so my guess is we may not get the move we are expecting, but I'm hunting that move because when it gets started, it's a screamer. When the guys who own puts decide to book their profits, they all just kind of do it at once, and you get this rip in the market. So I'm looking for it, but that first entry there is not, it just never set up. So I'm going to watch all the indexes here. So right now, this is a 3-minute chart of the S&P, the NASDAQ, Dow, small caps, and the semi-stocks. Hey, Brian OG makes a good point where, I personally, I'm not of the opinion that the White House wants to crash the market to bring down rates. I really don't believe that. But it is true that we have a lot of refinancing to do. And so there is this narrative out there that Trump and the tariffs and all the things they're doing, they're happy to do it now, early in his presidency. And one benefit, they know the market's not going to like it. And one benefit is it's going to drive up prices of bonds, bringing down interest rates. And so when we're refinancing, rates are coming down and it saves us trillions of dollars. And that's one argument, not necessarily that they're attacking the stock market to do that, but it's like a side benefit. Well, we need to make these structural changes, says the Trump administration. So let's make them now anyway. We have a lot of refinancing to do, and it's costing us trillions of dollars because interest rates are up here. So let's create. It's okay if markets crater and bonds go up. It's going to help us and save us a lot of money. That's a narrative that I don't disagree with. What it really means to me is it kind of dovetails with my opinion. This is the year 2000 again. And we're looking at like a 40% drop in a few months, to get rid of excess. And it just makes sense. It's all kind of coming together. So I think that's a good comment there. Hey, Ivy League, what's happening, man? Nice to have you. So triple QQQ are out of the question. I mean, you could do whatever you want, Dennis. I'm just not I don't think trading leverage right now makes any sense. So I do trade. I'm trading SSO, not S. I usually trade SPXL, which is triple the S&P. I'm only trading SSO right now. I could make an argument that I should only be trading SPY right now. I don't need the leverage. I mean, I really don't need the leverage. Maybe I should just be trading SPY right now, because in a normal volatility market, in the fat part of the bell curve where we have our day trading playbook designed for, I want triple performance because the market only has this type of volatility. So I want more performance. On a day like today where volatility is insane, all I want is one-to-one exposure. So I'm only using half my portfolio. And so I'm trading SSO, which is double the performance. I'm putting half the money to work, which is giving me 100% exposure. So every time I put money to work, all I have is S&P exposure 1-to-1. Okay. So if that's what I'm doing, then I should probably just trade SPY. And the reason for that is SPY is a $500 stock, meaning I'll trade. I get charged commissions even though they're tiny, right? But it is a cost. So why trade more shares? Because it's pennies per. It's like fractions of a penny per share. But I'd rather trade a more expensive asset and buy less shares. I should be trading SPY. And the spread's better too. Well, I think I'll do that. I think that's what I'll be doing. Oh, the market's crashing, and now they're getting to the utilities and they're getting to the pipelines. It's just they're going to get to everything. Yikes. Okay. Oh dear. It's getting ugly. There's nothing to do. May as well keep chatting. What do you got for me? Very funny. Very funny, Dennis. Shorting VIX. I don't want to get ahead of myself right now, but if this market craters to the close with absolutely no recovery at all, what is this? That's the longer term uptrend. We're getting some crazy prices on some assets here. You know, I had a piece of this on yesterday, you know, and I had to take it off yesterday, and the thing's imploding. Like all of a sudden, they're not going to compress natural gas. I mean, we're getting like crazy prices. This is God. It's going to set up. We have to figure out like what our top shelf of our whiteboard is, because we're going to get some unique opportunities in here on some investments. You know, they're in the proverbial throw the baby out with the bathwater right now. That's the market we're in right now. I think pipelines and anything to do with natural gas is a no-brainer. Look at the yields, 5% now on Kodiak gas. I mean, the chart looks god-awful, but I'm just saying, I mean, we haven't had a shot at adding to our AMLP position in a couple of years, really. I mean, a real shot. We've nibbled on it on the way up, but this is coming right back down. I mean, we own this cheap, just to be clear. We're using, now you're looking at weekly charts, daily charts, using the William O'Neill market surge product. But anyway, we own it down in here. Somewhere in this area is where we own. And this is back in 2022, we were putting these positions on. So we've held it all the way, and we're collecting a yield of like 8.8%. Attacking natural gas and pipelines, down 6% on the pipelines is like crazy. Glad I could help, Jay. We're in a melting down market. You know, we're in there's a serious problem. I was buying KMI here. Now it's back down below where I bought it. I mean, I'm going to be raising cash if there's no recovery. I raised cash yesterday from my turnaround dividend portfolio, just to give you guys for those who don't know. So we have a couple of investing portfolios. I call it innovative growth, and I call it dividends and turnaround dividend. All right. So the ARMR TD portfolio, I use weekly stops. I allow for more volatility. The only thing in that portfolio right now are dividend stocks. So these are the stocks that are in the portfolio right now. We're long utilities, AEP. We're long the pipelines. And in fairness, we've been long that for a long time. We're long Dominion utility, Duke, a utility, KMI a pipeline, EMB a pipeline. We've owned EMB from down here. So British Tobacco, Altria, which is actually up right now, Southern Company, AT&T and Verizon cheap. We own AT&T from back here. I still own AT&T. I bought it back here at 14 and change. So we've been on that for a while. And then this is a tobacco company as well. So we own 3 tobacco stocks, 2 telecoms, 4 utilities, and a handful of pipelines. Okay. So what would be attacking the stop? Friday at the close, and I'm going to be obviously having to sell KMI. I can't believe Enbridge is up there. I might just book my profit in Enbridge. I'm not selling AMLP, but the attack going on in the pipelines would get me to sell the other things. Okay. So I'll probably sell those 2. I raised cash yesterday by selling our Bristol Myers out. And of course, like I said, selling the KGC. And then what was the other stock? I had something else in there that I sold yesterday also, which is no doubt a little lower today. Like I said to you, I reduced my exposure to mining stocks yesterday by getting rid of Nugget and getting rid of physical silver. I did put on minor positions on these names. They're all going to have to go by the end of the day. Physical gold I'll hold on to. So we're in 70% cash right now. If this goes on all day, you know, we'll be probably closer to 85% cash is my guess, with 10% gold. So if there's no recovery. Oh, Cambodia to lower tariffs. You're going to start coming. Okay, we're at the location I'm looking for a trade. We're at that location. Now we're looking for some type of pattern to form that would be compelling. My favorite times to trade, 10:30, 11:30. On capitulation days like this, sometimes that, you know, 12:30 is a time, which is kind of weird. It's usually not a time I trade, but sometimes you just get a massive dump for 3 hours and then the market reverses. So anybody needs to go grab a bite to eat or something, which I do. I haven't had anything since I started my morning. So I'm going to go grab a bite to eat. I'll be right back. I'll bring it back to the desk. So I'll see you guys in a minute. I ended up not jumping off the desk. I was taking care of a couple other things. One thing is I've ripped out all of my metal stocks, so that's done. So you know, I don't know how else to say this. You know, I don't think I have to say it anymore. I think you guys can see what's happening. The market's imploding, and we got to protect capital wherever we can. So I put out those positions. I reduced my exposure yesterday on metals, but put out small positions on those 4 names. I just got rid of those names. I think I'm down to my fighting weight. My utilities, tobacco, telecom, I don't see myself selling right now, and they're not near stops. Probably KMI is going to have to go, and EMB, I should probably bang those out probably right now. So I may do that. I'm trying to manage my emotion from the point of view of this. This feels like an absolute market meltdown, and everybody's waiting to try to trade the rally. I don't know if that's really the best choice today, because we're so far down the rabbit hole of tail risk. I don't know. You know, I feel like I posted yesterday for all you guys a reminder of how the circuit breakers work. S&P down 7% on the day. They halted for 15 minutes. I mean, you guys haven't lived through that. Most of you guys haven't lived through that. Some of you, I know Brian OG. I mean, you've been on that. I mean, I don't know. I'm sure many of you have, but there's a whole bunch of you who've never lived through a moment like that. You don't. They halt the market, stops trading. 15 minutes. Then the market usually gaps down, starts selling again. Then they have to halt it again. I mean, it's complete insanity. And if it does that into the weekend, I mean, I don't know, guys. I'm trying to balance my experience in markets like this with, tempering my emotion. Do I really need to sell my utilities and my telecoms and my tobaccos? For the longer, 3, 4, 5 week period, probably not, because they'll be the first to come back when the market takes a break from collapsing. But over a 48-hour, 72-hour period, the market, it does some weird things, man. There's nothing in your portfolio safe when the market starts to go. You know why? Let me tell you why. It's not hard to understand this. Because people are getting margin calls now. People getting margin. Remember those dads I was talking to in the soccer field last night? They're all complacent. They're all going to hold. They're all going to be okay. It'll always come back, as it always does. That's the world that they're used to. Okay? And then they get a phone call from their broker. God forbid they're on margin. So what do? They say, I'm already buried in NVIDIA, and I don't want to take the loss. So I'm going to sell AT&T because I have a gain there. And so all of your best names get hammered in the teeth of a collapse because they're the only ones that are up. I'm making money in utility stocks. Sell them. My dad taught me this a long time ago. He used to be an institutional salesman. He ran the institutional sales side of Lehman Brothers in the late 70s. He started out as a research analyst, so he'd go all over the country, write up 50-page research reports, sit down face-to-face across the desk with institutions up in Boston running, billions of dollars. And that's how Dad got his start and raised me in that environment, taught me how to do fundamental research. And and really helped me understand the inner workings of the market. And here's one of his favorite stories and one of my favorites. So I'm going to tell you his favorite story. He was in a meeting with a manager in the 1970s, which is, you could argue we're in the year 2000, 2001 type of scenario. You could go back to the 1970s and it's probably like that. We have stagflation, right? And major geopolitical risk. And anyway, so it was a god awful market, but Dad's, up in Boston talking to a money manager, and the market's imploding, and he's trying to, have a conversation about whatever. And the guy stops him. He said, "How's that, Gary?" Because he's watching the market implode, and he gets on the phone to talk to the trader at the time, because there was no computers in the 1970s. So he gets to the phone, calls the trader, says, "Sell this stock that was in his fund, right? Sell it." And the guy comes back to him and says, "There's no bids for it. It's gone bidless. The market's imploding and there's nobody bidding. You're going to have to sell it X amount of dollars lower to find a bid." And he said, "Okay, forget that." And he looks at his portfolio to see what's up in the portfolio that's liquid. And he says, "Sell that one." He just wanted to get to cash. And if he can't sell the one that's illiquid, he'll sell the one that's liquid. If he can't sell the one he's losing a lot of money on, he'll sell the one that he's making money on. And that's why you get days like today. As an example, the pipelines. The group of pipelines are down 7% right now. I don't care what world we're living in. That doesn't, like, tariffs or not tariffs, right? That's got nothing to do with the amount of domestic energy going through the pipes. These are take or pay contracts. The dividends, it makes no sense. But people look at that part of their portfolio, like, I'm making a killing over there, and oil's down 7% today. Just sell it. That's the stage we're in right now. And trying to call the bottom of that stage, a lot of people are going to tell you on CNBC. In fact, did you see that I posted, I tweeted this out yesterday. If you're not following me, follow me on Twitter, on X or whatever, at Brett Rosenthal on X. Share this video with anybody you think could benefit from these conversations. I'm happy to chat with anybody. Anyway, retweet what you see. It really helps me if you retweet, right? I really appreciate the likes, but the retweet, what kind of helps others see what I'm doing. But anyway, Navarro came out yesterday. What's the exact quote? This is just, I thought this was so funny. I was like laughable. I had to share this with you guys on X. Navarro, advisor Peter Navarro, Trump trade advisor Peter Navarro, said this yesterday, and I quote, "Technicians are saying we're near a bottom." And they're probably right. I mean, God help us if the trade advisor is putting out quotes that market technicians that are looking at like how stocks trade, they think we're at a bottom, so we're probably right. I mean, that's like the dumbest tweet I've ever seen. I couldn't believe he put that out. Market technicians, give me a break. Market technicians are used to a bull market with Fed adding liquidity. They don't have the slightest idea, understanding that we're in tail risk right now. Massive tail risk. Anybody can say we're oversold. Market technicians, we're oversold. Every indicator out there is oversold. It's been oversold for weeks. And what do I tell you about those oscillators and indicators? They're worthless when it comes to oversold readings. When you get into a sell-off, they'll be oversold for weeks. There'll be little jumps trying to get out of oversold, and they get hammered again. The only way to use oscillators to really help you is to see a higher low in the oversold category. It'll be oversold for weeks in a bear market, and then it'll start to make a higher low, and you can start building trend lines on the oscillator. And you say, okay, maybe something's changing. Maybe we can get a little more aggressive here. But at this stage, technicians telling you the oscillators are oversold is a joke. Oscillators are always oversold on the way down. God, you know the other stock I had yesterday I sold? I just remembered it. It was One Oak. Holy shit. One Oak? Down 10% today? Whee! There's oil. There's natural gas. Natural gas is holding up. This is a domestic product, right? But look what they're doing to the gas goats. Holy smokes, man. We're going to get a shot at the gas goats. Just got to be patient. Here they are. Lord, have mercy. All right, I'm just going to run and grab a bite to eat. I'll be right back. I can't stay away long. It's like watching a train wreck. NASDAQ's down 20% now from the highs. It has another 20% to go. And then we'll match 2000. We're down 40% in 2 months. I should have bought some of that treasuries on that sell-off this morning. Shoot. DH Horton. Ivy League's looking at DH Horton. Hmm. 6% down. High yields collapsing. We got a major problem, boys. Oh my goodness. I like to keep it real on this desk and share everything with you. I don't just come on here and talk about all the great things that I do. I like to share things that frustrate me because it helps me exercise the demon. And I am just, I made money short the market. If you've been following me on X and armrInsiders, you know this. Since the 21st of February, Risk Monitor went red. I went short. I made money all the way down to the 200-day moving average. I covered it. Market rallied a bit. Put the short back out. Made some more money. Covered it in front of the tariff news. If I was an emoji, my head would be exploding. Yeah, I got a lot of alpha. I've protected capital. I'm carrying tons of treasury bills. That's all great. But I'm keeping it real with you guys. I tell you the facts. I share with you successes, and I share with you, moments where my head's exploding. And my head is exploding right now with the fact that I'm not short. It's like my head's just exploding. It's like taking everything out of me not to like literally put my exploding head through the wall next to me. Shorting is very difficult, and I'm always a cat in a hot tin roof when I short. So I put the short on, I make money, I cover it, market rallies, I put the short on. It looked like the market was putting a double bottom in, so I just figured I'd get out of the way. Book a profit on my short. Honestly, I thought the market was going to rally on the tariff news. I really did. Sell the rumor, buy the news. I thought that's what was going to happen, and I was going to put the short back out because the real reason the market's going down has nothing to do. I shouldn't say nothing to do, but I think it has to do with the AI bubble bursting and all that, and the fact that the Fed keeps draining liquidity out of the system all year this year. I mean, that's why the market's going down. And the Trump tariff tantrum is accelerant on those bigger themes. And I'm just, so on the one hand, yeah, I'm pleased. I'm building alpha. I'm protecting capital. All that's great. On the other hand, I'm just looking at holy smokes, the amount of money I could have made short in the last 2 days. And I feel like Peter Rabbit under the fence because not only did I cover my short, I went long the S&P into the tariff news. And the news, I was watching the speech, listening to the speech, and my long position was going up in the aftermarket. And then he pulled out that board of tariffs, and the tariffs were so much bigger than everyone feared. that it reversed back. That it was up in the aftermarket and it came back to where I bought it. And so I just sold it all right there. It was like a break-even trade. And like, you know, you always go over Monday morning quarterback everything. And it's like selling the S&P there made sense. And I should have been flipping short again. I mean, it was so obvious in retrospect, you know? Oh, God. Just a second, guys. Just a second. If you don't mind, just a second here. Thank you. Thank you. I feel much better. Now, if story's hitting the tape, here come the walk back. And this is why the market looks like it's trying to put in a little bit of a reversal right there. Yeah, we could have gone short on that candle right there. That's true. I just won't. I'm not looking to day trade short right now, Dave. I should be, but I'm just not. I'm just trying to get the long trade right now. But you're right. That was a flip trade short. Yep. So anyway, sources close to the White House say that the Treasury Secretary is trying to moderate the president's hard stance on trade. If he ramps it up, it would be the first significant in-house battle in the new administration, pitting Bassett against Treasury Secretary Lutnick and trade advisor Peter Navarro. Back in a second. Geez, I can't leave my desk here. I feel like that's the turn right there, and I should put some cash to work right there.
Order filled.
I'm going to put on a carry trade right there. Lower this bar is the stop. This right here is the reversal. That's the reversal. This is the buy bar. Takes the low of this bar out, and I'm out. You have to be wicked fast in this market. I'm not taking a lot of risk here. But I'm going to put on a piece right there. 513.39 is the stop. Now, if this is another bar like this one, right, where it ends up being a down bar, I'll have to remove it immediately. If it closes in the bottom, below, really the bottom half of the range, I remove it immediately, right? I'm not staying with the trade if it does that. So just a second here. We may not have a trade on if this is going to be a down bar. If it is, then I'll have my full trade out. Nope. Nope, that didn't do it. That bar is no good. It's got to close in the top 3/4 of the range for it to be a buy bar. Let's watch here and see if it does it. So I'm going to run and grab something in the kitchen. I'll be right back. And there it is. That's the bar. Well, that was a fast bar. That should be the turning bar right there. We're also going back above. The key here is that we're going back above the VWAP, and we're going above the both of the ATRs. This would be a wild buy bar if it actually goes up from here. The low of this location is the stop now.
order filled, order filled,
We'll use two stops. Not really. What's the low in this bar? 519. No, it's not 519, it's 514. Sorry about that. $514.75. Maybe even tighter. Right up there, maybe. Here we go. Here comes the news cycle of positive stories. The buy trigger here, is a pretty compelling one, which is this move. This big bar here took us above both of the ATRs and the VWAP, and that usually marks a major reversal on a huge down day. It may not be easy. The volatility could be insane, but that is what that's saying. There should be some upside here, and it could be pretty big. There's such losers on CNBC, They're just, oh, it's amazing, really. So if Vietnam's going to do something, Nike, there's your unbelievable opportunity on Nike probably. I already had Nike on my list of turnaround ideas, but just blew out through the bottom of that. Look, guys, this is the type of news that ignites the put selling rally. Let's go over what that is. It's been an unreal week for anybody who owns puts. Just incredible. You're making a goddamn fortune, okay? You're going to go into the weekend. Puts decay faster than calls do. So generally, these guys sell their puts anyway into the weekend. Now you're getting a couple of these announcements, and you're thinking to yourself, I've made so much money. Who knows what's going to happen over the weekend? Probably a couple more announcements. Maybe Japan, maybe somebody else wants to come to the table, wants to negotiate. Market skyrockets on Monday and wipes me out of my put gains. Forget it. I'm going to book my gains now. And that's what's going to create a skyrocket today. To me, that's the trade. Now, we don't know if it's going to happen yet, right? But if it pops back above that third standard deviation below the ARMR moving average and back above the key gamma level, then we got a ball game. Then something very interesting may happen between now and the end of the day, which would be a real nice update. So we have our trade on. We have our stop in here. You know, you can almost move it up to break even on the stop, so you're not going to lose money on the trade. But we're looking for greatness here. We're looking for a move above the gamma level that turns this into something big today. And it would make sense. All the bad news is out now. Market's cratered. Then we start to get, a couple of comments that are a little more bullish. And it doesn't change the overall bearish picture, but it makes for a great day trade. That's what I'm looking for here. We'll see. It's going to be hard to get through this level right here. This is the gamma level, the 520 level, right? So, actually 522. 520 is right here. This should be right. Oops. No, I had it right. 520. That's right. Back below this red line here, and the whole trade's over. And it maybe comes down, makes a double bottom, and we try again later today. 520.60, okay. 520.60. So it stopped right on it. I don't know about you, Dave, but I might want to increase my position size. If it makes a tight pattern in here and then breaks out above the 520.60 level and closes on a big up bar, I might want to increase my position size. What do you think about that? Or do you think we should be selling it when it hits that price? Exactly what? You said yes, exactly. Do you think we should be buying it or selling it? I think maybe if it's another big upstick here, I'd want to add to my position. Is that what you're thinking? Yeah, I agree. All right, we're in agreement. When Dave and I agree, usually good things happen. And by the way, we're not saying it's going to happen, not a prediction. It's read and react. If it does that, then I do. But if it were to pop above here, go like this, like bang, like that, I might add to my position size and raise my stop to the low of that bar. If it reverses back down, I'm out of the whole thing. If it skyrockets, I have an even bigger position on. But what we need now is for this price level to hold. I bet Treasury bonds are coming down, are they? Yeah, Treasury bonds got whacked. Well, that's tempting right there. I just put on a Treasury bond position right there. That's a double bottom on the opening range low. If this breaks down, it means that our carry trade's skyrocketing, and I won't need it. I'll probably sell it. If the carry trade fails here, that's probably a double bottom worth buying. And don't forget, if it closes above 93, I probably want to carry this. Boy, it's coming down right in here. What a bummer.
Order filled.
Well, I thought we were going to get that trade. $26, $27 bar. This trade's almost over. I'm long treasuries. I've got treasury position on. Yeah. That trade's over. Wow. All right, that trade is over, and I'm long treasuries. It might, if this holds here, I'll be long again in a minute. But this is the bar that took us out of that trade right here. So this was the green bar to get on it, went up a little bit and reversed, and we're out of it. So you can see it's a fairly tight stop right there, even though it's a wide day. So it could be a little bit bigger than we're used to.
Order filled.
Thanks for that summary, Aris. Much appreciated. still sniff a trade here. Oh, so here's where I bought treasury bonds. Almost like a hedge, right? Right in here on that double bottom. Okay. So now we got a double bottom on treasury bonds above the $93, this red line. So first of all, if it hits 90, it goes below 93, I'm out of the trade. And the only way I hold this overnight is it actually has to close in the top 2/3 of the range. Okay. Top 2/3 of the range. If it closes in the top 2/3 of the range, I'm holding that breakout of the downtrend overnight, over the weekend. I just wanted to share something with you that I thought you guys would appreciate. So those of you who are trading, with me, this strategy right here. So we have an algo strategy to trade the S&P only on a swing basis. Take a look. We've built this track record together. those of you who have been on the desk with me, we built this together. We started with the first trade back here, October of 2022. Portfolio's up 118%, which does not include the interest we collect on treasury bills in between trades. So that's just pure trading gains. Was it 29 months now? 29, 30 months? Okay. 118% returns, swing trading, where the average holding period is 9 or 10 days. During a bull market cycle, the holding period gets longer. So last year we had a couple of trades that lasted for 24 days, 28 days, 26 days. And then in markets like this, you get a couple of trades that last 1 day, 2 days, right? Because stops are hit. But the thing that I really think is fun that I want you guys to look at is that we're taking the cream off the top on these trades, right? So our object is to get in while the getting is good from the standpoint of risk to reward. The reward's great versus risk. We put the trade on. But now look what's happening to our performance. Look at what's happening to our performance. The market's crashing, and that portfolio is just sitting in treasury bills. Last trade number 20 we tried right here was a loss. Put it on the next day. The next day I hit the stop. It was a loss, right? So we have 2 losses in a row. Trade 19 was a loss. Trade 20 was a loss. We have very tight stops, right? But it's cratering. And so the next time we are just stacking chips on top of alpha. I mean, the alpha is going like this. We're stacking chips on top of treasury bill income that keeps coming in. And then we'll get a trade. And so it makes it worth it every time to hit that trade, every time. Yeah, there's going to be a couple where we lose money. But see, the couple that we lose money, the losses are quick and tight. And it means the market's going down, right? The market's, in this case, cratering. Man, when we get our next risk on trade, I can't wait to put that money to work. I might use my whole innovative growth portfolio to trade that strategy until we get out of this bear market. Then I don't want to put anything else in the portfolio. I'm not buying innovative growth stocks. You know, trying to manage a portfolio of a whole bunch of stocks in this wild volatility it's very difficult and usually just costs you money. The real money that's made in the bull market is after you turn the corner, which takes months. But there'll be swings. We'll get day trading swings that turn into a 1 or 2 week rally. And so this portfolio I'm going to be focused on. My entire innovative growth portfolio is going to trade this strategy only. Risk on, bang, I'm going to put the trade on, make some money. And then if we start to make higher lows and build a base, then I'll start buying innovative growth stocks again. It's now or never. It's now or never for the market. It's got to hold right here. I might nibble away. I think we have to execute a little bit differently on a day like today. It's just too hard. The swings are so violent that it's hard to pay up for it. The loss, even though this was the right exit point, the loss was still too much because it's a wild swing. It doesn't look so wild, but when you kind of zoom in there, it's huge moves. So if we're going to put a trade on, it has to be tight right in here. This looks like, so this was the original entry point, and then some news came out, drove it back down. So buying it right here on that low of this bar, that's kind of the location trade that I'm looking at now. Putting out a trade right there. If we close below that line, then forget it. The market's just going to keep plummeting. I think those tails right there, if it builds a base right in here above those tails, I think we need to be long in this area, and I'm not going to pay up for it when it pops. Or I might, my last piece will be, I'll pay up for it like that last piece, but it won't be the full position. You know, it's just too volatile. The market's just crazy right now.
Order filled.
Yeah, you're going to get your shot. What's possible? Oh, high or low. Yeah.
Order filled.
So that was the powder keg, and you had to be filled already. I don't think you can chase it. We don't even know if this is going to be if it closes in the top part of the range, that's the last place you're able to do it. This will be the last spot. Because if this breaks, I mean, so there's your last location. You know, if you can put a trade on there, that's going to be our last chance is right here. So I mean, it's worth giving it a shot, because if we actually take out the low of this powder, I mean, it's ugly already, but I mean, disaster. God damn. I'm going to book my gain in treasuries. There's a pivot high, a couple pivot highs there in treasuries. I'm just going to take a break for a minute and see if this carry trade works. I might come back to treasuries.
Order filled. Order filled. Order filled.
What news is out there that would have totally collapsed? So silver's an industrial metal when they decide to beat up industrial metals, right? So that's why they're killing silver. And of course, the mining stocks get killed when silver's going down. They just routinely beat up the mining stocks. Gold down to the 25-day moving average. I wouldn't say that's got anything to do with anything today other than, normal pullback to the 25-day. I mean, that's kind of what's happening to gold right there. That was, almost like an unsustainable walk straight up. So it's coming in, might even come down to the 50. I think that would be probably a buying opportunity for gold. I might double my gold positions down there on the 50 if I get a shot. But I didn't hear anything out of Trump or tariffs or Powell that would put gold down 3%. And it's just a good example of, when things are imploding, everything gets sold. But the fact that Bitcoin's not down is astonishing to me. I don't know if that's like I should be shorting it like crazy because it's about to crater, or I don't know, it's some store of value. I mean, I'm not going to short it. I'm just saying that's amazing. It's a sea of green on my screen, of red on my screen, and the only green is treasury bonds, and Bitcoin, and the U.S. dollar. I mean, the dollar's up, so I guess you could say gold's going down because the dollar's up today. I guess it doesn't really matter on a bigger picture. From day to day, though, you can always point to that if you want to. So we have another double bottom here. Keeps brewing. Got to get above this location here for this to turn into a profitable trade. Got to get above really 519 really. Until it does that, the jury's totally out. Home builders are up. That's strange. That's for sure, Aris. What are the top names we want to own when the washout's over? So Ares brings up a really good point. Now's the time to be building our whiteboard. Our whiteboard is our wish list of our favorite names, names we thought had gotten away from us, names that we missed. Oh my God, I'm never going to get it. They're all coming down to us now, and we got a boatload of cash. So now is our time to build that whiteboard. But like I said before, what I've said before is we just did this. We just built a whiteboard. And what I said to you is I want a couple of those names to get away from me. If they get away from me, then I know that a shift has happened in the market and I can start putting money to work again. And so the next crop that come up, I'll start buying. So I've got that wish list. But one of the pitfalls of a wish list is that you start building a portfolio too soon because you don't want to miss it. You don't want to miss it. And what I'm suggesting to you is build that whiteboard and miss a couple. Oh, great. Those two blew out. Now I can start putting money to work. It looks like this trade's over. Wow. Okay. It's been
Order filled.
That's a pretty ugly situation right there. That's might be time to get back on treasuries. Oh dear. All right, off the desk for a couple of minutes here, guys. I'll be back. All right, guys. I mean, the market just keeps bleeding all day. Now we're down to the lows of the day. So obviously, there's one more setup for another trade today. Who's ever got firepower to still keep taking shots here? I don't see anything setting up yet, but you can see that little double bottom there, and it's on this original V bottom. Okay. Market is challenging those lows. It's just attacking everything right now. It's almost best to walk away from the screen. Normally I'd be out there going over charts and kind of going through stocks that are, popping up near the pivot using these types of strategies. But on days like today, there's no point in doing any of that work. And there's also nothing showing up. Here are like recent breakouts. I mean, everything's just cratering. It doesn't make any sense. The only thing, with a red dot, look at that. Relative strength blue dot line. That's always interesting. 121 names are doing better than the market, but they're cratering. I can't believe that's a blue dot. That thing's getting crushed. Black Hills. Black Hill is one of my utilities I wanted to add to the portfolio, but I mean, it's just obviously they're doing better than the market. Everything's just getting hammered. So everything's skewed today. There's no point in going over charts. I'm not even sure there's a point, quite frankly, in working on my whiteboard today. And I gotta be honest with you guys, the only decision I have to make today is, and I think we all have to make, I mean, I can't help you with this one. We all have to make our own choices here, but I've been saying to you for a while, if it gets ugly enough, they're going to get to everything in our portfolio. So we have this 15% of our portfolio that are in dividend stocks and stuff like that, and they're going to kill them. And so today they got to them. And so the only decision I have to make is, do I want to hold them? It's 15%. So it's not a large position, right? And this is like an outsized day. So it makes it look like, gee, you know, portfolio's down today. But obviously I'm dramatically less than the market, which is great. So we're stacking alpha and we're doing fine. But it's just, how bad is this going to be? And do I want to hold it? And I like to say that I had a really great client. You guys hear me talk about her all the time. And that's General Millie Hedberg. She was she was the first female general in the U.S. Army. She's a 3-star general. She was just great. I loved her. God rest her soul. And at the beginning of 2008, after a couple days like this, I called her up and I said, Millie, and she let me use her first name. I said, Millie, I think we got to sell everything in your portfolio and just go to cash because something's wrong. I don't know what's going on. And all we had at the time, we had a portfolio full of pipelines because she liked to jet set around the world in her retirement and play golf all over the world. And I remember this particular conversation. She was in Ireland when I was having this conversation with her. She was on a golf course in Ireland when I was talking to her. I was like, I don't know what's going on, but I think we need to just get out of everything and go to cash. And she said, Brett, you know, I kind of live off the dividend checks we get. You know, she had her pension and everything, but she really loved that I set this portfolio up for her where she just wanted to maximize returns and get a check every month. And so I said the best way to do that was pipelines. This is back in 2006, 2007. She was doing great. And so her net worth was going up and she was collecting this phenomenal yield in pipelines. And then I called her and said, I think we should just cash out because something crazy is happening to the market. She said, well, do you think that something fundamentally is going to go wrong with the pipeline industry? And I said, no, this has got nothing to do with pipelines. It's not like, you know, back then there was the concern, every now and then there was a concern that politicians were going to close the loophole on master limited partnerships for energy. The MLP was originally created for a depleting asset. So it might be like an MLP for a timber company. You keep cutting down trees. Okay, so your assets being depleted. So part of that's a return of capital, and you're paying dividends, and it gets shielded. It's a tax consequences are shielded, so the yield is higher, right? That's why they created MLPs, and then they used an MLP for a pipeline, which is very clever. But the assets really never depleting because more and more and more gas and oil go through the pipeline, right? And so it's always been a loophole. And so every now and then, I digress, but back then there was always the concern that some politician would close the loophole on pipelines, which would totally screw that sector. In fact, that's why Kinder Morgan went to a corporation. During that period, there were a couple of companies, Kinder Morgan and a couple others, that scrapped the MLP and went to a straight corporation instead of a master limited partnership. It's an interesting story. But anyway, so I said, Millie, I don't know, man. It's early 2008 and things are getting dicey. And there's a couple of days that look like what we're seeing right now. And I said, I think we should just get out of Dodge. So she said, is there anything wrong with the pipelines? Are you afraid that like they're going to close the loop? I said, no. It's got nothing to do with pipelines. It's got to do with the market, something financial. The financial markets are having a problem. And she said, well, look, as long as you think the business is sound, I'd rather get those checks every month. And it's okay if my net worth goes up and down. So, okay, we're going to hold it. Her portfolio dropped 50%, 50, because the market was imploding and they just killed everything, 50% might be too big. Because the S&P was down like 50, 60%. Maybe she was down less than the S&P. So maybe it was like 35, 40%. But it was a lot. It's a big move in an MLP portfolio, okay? And she was cool about it the whole way through the financial crisis. She didn't care. She kept getting her checks, and she was okay. And, of course, we came out of that. The Fed started buying everything in sight, liquefying the markets. She actually brought more cash into her portfolio in maybe April or May. March 2009, the market bottomed. In April and May, she's like, let's buy some more. Okay. We bought more after it crashed. And, man, her portfolio went on to be one of the greatest portfolios I was running, right? Because we just loaded up on MLPs and they went through the roof. So I tell you this story because you're at this key juncture. We're at this key juncture in the market. The market's behaving as it did in 2008, as it did in 2000. There will be rallies along the way. I mean, it's not just going to go to zero. So there'll be rallies along the way. So we don't have to make this decision today. So when it bounces, you can make the decision. It might go lower next week and then come back to this level. And in a couple of weeks, you're making that decision at the same level we're at now. You know what I'm saying? But a decision's going to have to be made. I was just talking to my sister. I manage her capital for her. And I was just having this conversation with her. If you can make it through that swing and your portfolio is just collecting yield and you want the dividend checks, then you have to walk away from the screen. Don't come to me a month from now with the market even lower and the stocks even lower and then puke it out. It's like a decision you got to make. And you say, either I'm going to hold these things and Duke and Southern Company and AT&T and Verizon are going to pay me their yields, or you have to get out of Dodge and hold Treasury bills at 4.3%. And it's a hard decision to make. You know, it depends on your risk tolerance and your goal. And the reason it's a hard decision to make is you have to really look inside yourself. Who are you? What kind of person are you? Because I can tell you from experience that like 90% of the investors I've worked with over the years, and I've worked with a lot of investors, okay? And like 90% of them can't handle the milli moment. It craters, their net worth drops, and they puke out right at the low. She was done. She didn't need to know about it. Just tell me when we should buy more is what she told me. Just when should we buy more? And I didn't want to buy more, but once the Fed started doing quantitative easing a couple of months into that, I was like, well, I guess we could buy more now. Okay. So you either have to walk away from your screen and say, okay, my allocation to dividends, I'm going to stick with, or you need to make a decision, you know, in the coming weeks. Maybe some of it today, maybe some of it over the next couple of weeks. You can cut. It's not an all or nothing decision. You can cut the position down and it rallies up. You can sell the rest of it. You know what I'm saying? It's a process. But the S&P's dropped now 10% in 2 days. That is not normal. And I know we're all sitting here saying, well, there could be a snapback rally. There'll be a whole bunch of tariff deals announced over the weekend. Market will be up 10%. It's possible. It's just incredibly hard to make a decision right now. For our flagship fund, we're sitting in 70% Treasury bills already. And so we only got 30% of the money to work. And we're getting hit today. I mean, yeah, we're down dramatically less in the market, but we're losing money today. You know, gold's down 3%. Pipeline's down 7%. You know, everything's down 3s and 4%. I mean, it's just an annihilation. So, and we're nowhere near close to the Fed coming out there and, you know, having a Fed put where they're going to come and, help rescue the market. We're not even close to that. I think this could be locked the limit down before the end of this day here. We're just losing ground rapidly. How funny is that, Ivy League? I mean, we're getting close to a circuit breaker. I mean, and then once they start sending that message around, it becomes a self-fulfilling prophecy. I do think it's decision time, and I can't tell you what I'm going to be doing because it doesn't make any sense. I don't know who you are. I don't know what your risk tolerance, your goal, or whether or not you're a Millie Hedberg or you're a faster trader. Only you can figure that out. For us, I'm talking about like 15% of the portfolio. So it's not a great large number, but at the same time, for some portfolios I manage, it makes sense to get it all out. Get it all out before the end of today. Treasury bills and gold. I'll probably hold gold's down 3%, but I'm probably going to hold physical gold. But some portfolios I'm running are going to be 90% treasury bills, 10% physical gold by the end of the day today. I'm just telling you that right now. So Ivy League, I look, I don't disagree with you. And on 90% of the days, Friday into the close, the most important 2 hours are ahead of us. We're all looking for the market to rip higher, and it may do that. This day is not normal. So don't shoot till you see the whites of their eyes. That's my thought here on this day. I keep seeing entry points that look good to me, and they keep failing. And I know everybody's out there. Puts are going to cover. Puts are going to sell. They're going to sell the puts. They're going to sell the puts. They're going to sell the puts. If you get to 3 o'clock and they haven't sold the puts, and everyone's waiting for that call, market was down 5% yesterday, or 4% yesterday, down 5% today. I mean, somewhere in here should be a face melting rally. I have already begun exiting for some of my portfolios, just every position. I'm just like, that's it, man. Treasury bills, physical gold, and maybe a treasury bond position. That's it. I need to start over. And of course, there could be a wild rally in the afternoon. Market could close flat on the day. We've seen that happen. I don't know how I'm going to participate in that, but I know something is definitely broken. This is not normal action. I think if we get lucky enough to have a bounce off the bottom at the end of the day, I'm going to be selling into it. Yeah, I know you're with me, Ivy. Sometimes, Ivy, when I love when you guys make comments or ask a question, because then I comment on it. And while I'm talking to you, I'm also talking to everybody listening. So somebody's thinking what you're thinking. Yeah, I'm not. Maybe I'm a little more aggressive in that situation because I know you're a trader and you get it. I don't imagine you're firing right now, but somebody else that's listening to this conversation or reading these comments might be. And so I'm just sharing with you. I don't think this is normal, a normal day. But look, there could be a great trade that's about to develop. I mean, I'm sitting here trying to figure out where's the entry point on that. It probably won't look like anything that we're used to. It'll just be reverse and skyrocket. That's the So it's almost like a timing trade. Anytime after 2 o'clock where something sets up, maybe possibly, maybe that's the time. But even then, these things reverse and skyrocket at a moment's notice. It's like it's just incredibly hard to put on a trade today. Treasury bonds are breaking down now. That should be bullish for the market. Oh dear. I'm all out of my treasury bonds for now. I'm not going to carry that here. Bonds just cratered, so I imagine the stock market's going to try to rally here. 145 entry. It's worth it right here, trying to break the downtrend. But that close right there on that bar just wasn't good enough again. Maybe take out the high of that bar and get a trade on, and lower this bar with the stop. I mean, this that might get me to just remove all my utilities. You know, the utility index is breaking down. I can hold Duke, but I mean, what's the point? I've got gains in these things. I'm probably going to book the gains across the board by the end of the day. Probably not going to disturb this position. It's such a long-term hold, and I'm probably not going to disturb AT&T. Probably going to let Verizon go. Let's see where we are later. Plain and simple, Ivy. I mean, it would be a shocker to have two 4+% down days in a row on the S&P. There should be a long trade here that recovers, the market recovers into the close. I mean, there should be. If there's not, I mean, you just got to protect capital, you know, and worst case scenario, market gaps up huge Monday. Okay, so what? We'll start rebuilding, you know. This looks like an entry.
Order filled.
It's a 51 bar though. It's like, so you can't put the whole trade out yet, but at the same time, you got to buy it close to the base. So I don't know. Maybe what I got on, I'll just hold if it rips higher. If it doesn't, I'll be out. It's going to be another tail.
order filled,
So there's no position there. You can see that that was a tail. It wasn't actually a buy bar. So can't hold that position. We have to stop trading, and from the standpoint of trying to come up with what's next. We can trade, but I mean, like, I'm not going to hold treasury bonds over the weekend. Here's the problem with owning treasury bonds over the weekend. They're up in reaction to the ass kicking the market's taking. Let's say I just saw a story hit the tape, US and UK working on a deal. That deal comes out over the weekend, market's up 5%, and they're killing treasury bonds. So the treasury bills, that's the investment right now, just treasury bills. The dust settles, a base gets built, we start putting capital back to work. That's it.
order filled,
Right, that's the setup. See if it results in anything. Trade at your own risk here. There's the double bottom setup, the breaking of the downtrend back above that third standard deviation below the ARMR moving average, attempting to get back to the VWAP here. We'll see what happens. So you can see that's gone through the stops. So there's no, I mean, this market's just toast. It's just, boy, it's going to be ugly. So that was the last gasp of the market, and now if it's going to be doing this into the close, there just can't be any positions on the portfolio. So I'm tidying up the portfolio here. Okay, guys, I'm cleaning up the portfolio here, and I'm just taking gains where I've got them and cutting losses where I have to. And I think the only two positions I'll have left at the end of the day in the flagship fund are physical gold and AMLP. That'll be it. I think those decisions have to be made before the end of the day, because if it gets ugly at the end of the day, I'm not exactly sure you're going to get prices you want. Girls, you're going to have to leave the office if you're going to be barking like that. Huck, what did I tell you, girl? Hush. Don't you woof me. Uh-huh. All right. I mean, I'm just, changing the portfolio aggressively here. And the only thing I have left in the portfolio are the pipeline. The AMLP, look, I've owned it for 3 years, down 7% today. I'm going to live through that one. And I've got my physical gold position on. And I've booted everything else. And I'm in the process of buying May Treasury bills with the cash balances. And let me, this is the 2:30 update, let's call it, right? So this is the 2:30 update. On days like today, I've done the research. Look. I've done the research on this. I've went through multiple optimizations of all my different algos. Statistically speaking, if the market's doing this at 2:30, I don't wait till 3:30 to sell, because there are days when the bottom just falls out of the market and the bids disappear. And statistically speaking, whatever I get at 2:30, I can get at 3:30. It's pretty much the same, but I avoid the air pocket. Now, it's hard to believe there'd be an air pocket today because we're already down 5.5%. But I've learned that over time, it's not that big of a deal when it comes to exiting my positions, waiting for the extra hour. And if you do that and the market's going like this, you're just getting screwed from prices. So this market should have recovered at 2 o'clock. That entry point at 2 o'clock should have made money. And it failed. Now, we can make a double bottom here, and the market might just do this the rest of the day. Okay? But the worse this gets and the longer people wait, you get closer and closer to bids that disappear. And so I'm done. I'm done. My carry trading lost money today. It was a brutal day trying to make money carry trading. We're using smaller position sizes. We're using, SSO and it was a brutal day. I mean, everything was reversing and the moves are big, even though we got smaller sizes on. So tough day today. It's like 100% down day. And there were like 2 or 3 trades we tried and it just didn't go anywhere. And then the big down bar takes you out. So some days are like that. It's okay. We'll be back at it next week. So I'm setting up portfolios to be able to carry trade next week and to be able to look for, over the coming weeks, the swing trade in the S&P. That's all I'll be doing on this desk now. That's it. There'll be nothing else in my portfolio except for 2 investments. The pipelines, which I've held for almost 3 years now. And so one day is not going to get me out of the pipelines. And Sprott physical gold. Okay, I guess 3. I haven't sold my AT&T yet. I'm long-term on AT&T. I probably could sell it. We've already doubled money in AT&T, but we've locked in that fat yield. I haven't thrown that out yet. So I guess there's 3 positions I still have. Everything else is out. Here's why. I mean, just look at the utilities as an example, okay? And by the way, we're booking gains on the utilities. It's just if the utility index is doing that, I can't sit there and hold utilities. It doesn't make any sense. So we booked a profit in Duke. We booked a profit in Southern. We booked a profit in AEP. Took a loss there in Dominion. Those are out. Altria. I could give it another day, you know. British Tobacco, I'm out. UVV, I'm out. This was never, this was just a 6% yielding stock, and I'd rather hold Treasury bills. There's nothing wrong with that position, but I took it out. I do have a little bit of MO left, but for all intents and purposes, out. Altria out. So to go through this now, this is the turnaround dividend report. This would normally be a 3:30 update, but you just, I can't wait till 3:30 on these trades. I've been here before, and 3:30 is not kind to a market that's imploding. So AEP is out, Dominion's out, Duke is out, Kinder Morgan was out earlier today, EMB was out earlier today, British Tobacco out, Altria out, Southern Company out, Verizon out, UVV out. I've got AT&T and AMLP, which are both down 7%. I should be out, but I'm holding those at the moment. Okay. I'm holding those for a day here. And I still have spot physical gold. That's it. And so what I'm doing now is shoveling a whole bunch of capital into Treasury bills out till May. You can go find the Treasury bills or anything 12 months or less. So rolling them usually go out a couple of months. For a while there, further out, like 6 months, had a higher yield, but I don't think that's the case now. So May is all I have to do. And the reason to do Treasury bills is so if I'm looking for a trade next week for, let's say I'm going to be looking for an S&P trade, I think I'll probably shift gears again next week. I was using SSO today. Now that I've got nothing in my portfolio but Treasury bills and a couple of small positions, all I have to do now is harvest alpha. Even though I'm down today, we're down a lot less than the market. So another day, and this week our alpha is enormous. Whatever you might have lost this week, your alpha should be enormous compared to indexes, okay? So all I need to do next week is maybe get some exposure to the biggest index, S&P. That's it. And so I wanted to clear the decks, clear my mind, focus on that next week. And if it ends up being a position that I put on and have to take off by the end of the day, or I put on and I want to take off by the end of the day because I've made money and I decide I don't want to hold it, I want to make sure I'm collecting my interest. So all the portfolios need to own Treasury bills so that I can then go put S&P trade on and either book a profit by the end of the day and still collect my interest, or maybe I carry it overnight and I can always reduce my Treasury bill position. So I'm gonna work it like that. I also, not to be an alarmist, but if there's dislocations lower on Monday, I would rather own the Treasury bill than be in a money market fund. We learned that in 2008. Sometimes what's in the money market fund is not what you thought was in the money market fund, remember? And so a couple of money market funds broke the buck in 2008 because they had a higher yield. They enticed you with a higher yield into the money market fund. They didn't tell you that they were buying lousy mortgage-backed securities that went bust. And so they couldn't, right? So we're not fighting last year's war. I don't know what it's going to be this time. It's probably not mortgage-backed securities, but who knows? I don't want that, right? I want, as much as I'm content with the cash management system of Interactive Brokers, I'm more content with Treasury bills in all of my portfolios in a market like this. So word to the wise, Treasury bill, defend, defend, defend. Okay? And that's what I'm working on right now. Hello? This is the Armageddon moment, guys. That's what it is. All right. So that's been done. Any question you guys got, I'm here for you. You'll see my 3:30 update is the same as my 2:30 update, you know. Hmm. Hey, so Chicago, Dave shared with me, maybe you guys saw this on X, and I saw it last night on X, where, there's this former Democrat who's on Twitter, on Fox News, or no, CNN, it looks like, and she's explaining, the tariffs on Piers Morgan, and she's saying, and I had a real problem with this, Dave. I thought some of the things she said make sense, and then everything she said just kind of threw it out the window because I think she's ridiculous. Okay, and I think the comments right here. Here's the truth about tariffs. 60 years. Blah blah blah. Okay. Donald Trump's the first president in the generation to tell Wall Street to screw itself. Okay, he's for the working class. That what she's saying is class warfare, and it's total bullshit. Okay, because he comes out and says that Wall Street's punishing Trump. Wall Street's doing this to Trump. And I think that's just it's a total bullshit. Okay. Well, there's not a whole cabal of people on Wall Street that are crashing the market just to get back at Trump. I mean, come on with that. That's just ridiculous. You know why the stock market's crashing? And I happen to think what Trump's doing is great. I think it's long term, it's great. Okay. But the stock market's crashing because what Trump's doing makes it impossible to model earnings and revenue in the future. You can't possibly model it. And the entire stock market's built on looking forward 6 to 9 to 12 months, coming up with an expectation of earnings and revenue. Institutions make investments. You can't do any of that right now. And so everyone's running for the hills. It's not a personal vendetta. It's unreal, unbelievable uncertainty. Market hates uncertainty. Markets always hated uncertainty since like the buttonwood tree. The market doesn't like uncertainty. This is not about getting back at Trump. It's impossible to put money to work in a market where you can't model it. You don't know what's going to happen next. And so everyone's just saying, okay, screw it. I'm out. That's what's going on, So I thought a lot of what she said made sense, Dave. And then when she started like railing against some boogeyman on Wall Street who's trying to get back at Trump, I was like, this is just ridiculous. That's my opinion. That's my take on it. And furthermore, I don't think Donald Trump is telling Wall Street to screw itself. I mean, that's just a whole bunch of bullshit. Donald Trump is saying we're rebuilding the country the way I think it should be built from the ground up, manufacturing, put people to work and all these things. And there's going to be pain now, and hopefully, before the midterm elections, we'll be able to, reverse that pain. I mean, that's what he's saying. And so from the standpoint of he's a president who's not watching the ticker tape, more power to him. Good for him. He shouldn't. He should go execute what should be done. So I think she would have been a lot more effective on Piers Morgan if she stayed away from the class warfare bullshit and just talked about what he was doing. It's my opinion. Yeah, the risk monitor did call the COVID bottom. Yeah, it did. So you're wondering when to get back into the market, right? And so the risk monitor red right here, market crashing. There's no, I mean, we're below the second standard deviation, below the 200-day moving average. So this is the tail risk event. This is something, anywhere inside these bands is just normal volatility. Outside the bands, and you're starting to get into a zone. And I know that the knee-jerk reaction is, well, we're outside that band, so we should be buying here because it should snap back. Statistically, that's true. You're getting so far away from bear market collapses, you tend to live in those tails for a while. So there's going to be snapbacks along the way. Who knows? It could be Monday. There could be great stories over the weekend, and the market, median bar reversal, crashes today, up big Monday, rally back towards, the moving average. It could certainly do that, You would expect it to do that. But I'm equally concerned after, like I say, the year 2000, stuff like that. These sell-offs get pretty aggressive. Truth be told, I haven't seen anything like this. So I kind of take that back. This is not what happened in the year 2000. So, if we go look at the year 2000, I mean, I thought we were here. This was a 40% decline in the market rally. All the way down in here, you didn't have any of the action like we're seeing now. This is unprecedented. I've never seen anything like it. I guess maybe I did in 2008. I bet. I don't know. I don't even know if there were 2 days in 2008 where the S&P dropped 10%. I don't know. Let's see if Grok can answer that question. Yes, there was an instance in 2008 where the S&P experienced significant sell-offs over 2-day periods, including drops exceeding 8%. 2008 marked an extreme volatility. Okay. One specific example was September 29th to 30th, where the S&P dropped 8.79%, triggered by the House of Representatives rejecting a $700 billion bailout plan, exacerbating fears of a financial crisis. On September 30th, the market rebounded slightly with the S&P gaining, and investors anticipated. However, we look at other 2-day windows around the same period, declines were even more pronounced. Another candidate is December 1st and 2nd, 2008. Market dropped 8.93%. So the last time the market dropped like this was during the Great Financial Crisis. We got an hour left. Is the market going to try to recover some of this in the last hour? I don't have any firepower left. I don't think I'm going to be trading it, but there's another setup. Market could try to come back here. It's going to do that without me, though, I think, which, sometimes that ends up being a trade that works. I needed to keep my losses a little bit smaller today in order to trade this now. At this point, I'm out of the game. So, but anyway, if anyone's still trading, There's there's a possible double bottom again coming into the last hour. And you usually want to try to have enough firepower to put this last hour trade on. A move back to the VWAP would be a normal thing, like 515 area from 508, which would be an enormous move.
Order filled.
Yikes, that could be me putting an order in. Don't tell anybody. Hypocrites, Kevin, total hypocrites. I remember that, Kevin. Wild swings. All right. Well, I'm on the last carry trade of the day. I was just too. I don't want to write it into the room. If you guys are going to do it, do it. I don't want anybody to be compelled to do it at this stage. But let's take a look. I'm sorry, I got off the track here. Hello. So question was, would the risk monitor, what was the question? Will the risk monitor find the bottom? You said here, did the risk monitor call the COVID bottom? Yeah. Well, there's two things that really call the COVID bottom. The answer is yes, the risk monitor called the COVID bottom. 2020, we got a risk on green signal. And it really coincided, Dave, if you remember, with the Fed announcing that they're going to start buying everything in sight. Like that was one of the easiest entry points ever. The Fed came out and said, we're going to be buying corporate debt, which we've never seen them do. Remember that? And so, you could see the turn in all the indexes. And so, yeah, I mean, we were out there putting money to work off the bottom. I think a better time frame for so I'm not sure what your question exactly is, Dave, but I would say this: I have 100% confidence in the algos to find entry points along the way in this bear market. Okay. And if you'll allow me this moment, in all humility, to say, I've been telling you it's a bear market since February 21st, right? And now today I hear CNBC, it's official. QQQ is in a bear market. It's down 20%. I mean, who does that help? That doesn't help anybody, right? February 21st, risk monitor went red. Something seriously wrong with the market, okay? So the risk monitor catches bottoms and tops. That's why it's so effective. It's because, and it's not a crystal ball. It doesn't guess what's going to happen. It tells us what is happening. When we see those 10 indexes all move together in the same direction after massive selling, that's institutions starting to put money back to work. And we're going to see that. Now, we just did a little bit of quick research on Grok. The last time we can find a 2-day move where the market, the S&P, dropped over 8%, and right now we're looking at 10%, is 2008. So is this 2000 to 2001? That was my scenario. I thought we were in the year 2000, 2001. But then, as I said in the morning meeting this morning, the Trump tariff tantrum is like an accelerant on what was already a problem with AI and bubbles and all that type of stuff mixed in with the Fed reducing liquidity. So we had AI bubbles and the Fed taking liquidity out of the system all year this year. It's not a big surprise the market's going down. And then this is an accelerant to crater the market. The problem is you never know you're in a financial crisis until you're, looking back, oh my God, that was a financial crisis. So what happens at this stage is there are, without a doubt, big players, institutional players, we call them hedge funds or whoever, the institutional players that are caught naked right now. Okay. they've got too much leverage on the wrong side of a trade that you and I aren't even talking about. I don't know what the trade is. Could be a currency swap. And they've got way too much of one thing thinking this was going to happen and they're getting screwed on it. And it becomes a snowball. Could be a debt problem. There's all types of issues that we don't know is happening because of this market wreck. And so that's what happened in the financial crisis. It just kept rolling and rolling. You would put a Band-Aid on one problem and, you grab the balloon here, it would pop out over there. And then you try to grab it here and it pop out over there. So I don't know what type of market we're dealing with right now. But if we just go by, it's not often we see a 10% drop in 2 days in the S&P. And the last time we saw that was during 2008. And then we layer on your question of what will the risk monitor do for us in a market like this? It's going to be hard, Dave. There were 4 risk monitor green entry points in 2008. Hit stops within a week. All 4 lost money. A portfolio only following the risk monitor and only putting money to work in the indexes. Every time the risk monitor went green, I think that portfolio, when I did the model of that portfolio, it was down like 10.8% for the year in 2008. Market was down over 55%. It was down 10.8 because there were 4 trades we got on and 4 trades that immediately hit the stop. And the average stop on a risk monitor trade is somewhere around 2.5%. So it's going to be hard, man. And so what I would submit to you is that model that I just shared with you is, putting all the money to work every time there's a risk monitor green during 2008. And what I would learn from that process is probably position size. You wouldn't have to put all the money to work. If we're out of the market and it's crashing and we want to harvest some alpha, maybe 50% of the capital goes to work. So if there's 4 failures in a row, instead of a 10, let's call it 11% loss, you're looking at a 5.5% loss with the market down 50, 60%. I'll take that. Do you know what I'm saying? So I will trade risk monitor green entry points this year. But because of the way the market's trading now, I would probably manage my position size. And what I like to say is earn the right to take the risk. So we get on a risk monitor green signal. If we're able to make money on that one, risk monitor red, we get stopped out, we book a profit. Okay. The next time we get risk monitor green, I might put more capital to work because I've earned the right to do it. I've already made money on the first trade. So, okay, maybe this year isn't 2008. And so now we can start building on it. Do you see what I'm saying? I think that's going to be the best way for us to deal with the market this year. Yes, I'm going to trade the swing. But as an example, the triple swing strategy that only trades the S&P, right? It's up 118% in 30 months or whatever, right? The last 2 trades were losers. So like if we get that entry point, how am I going to use that in my portfolios? I'm not carrying triple S&P overnight in this market, but I might put on a 1-to-1 position. I might just have SPY in the. I might put half of the portfolios in SPY. I'll have 50% coverage of the market and hold that overnight. No leverage. Like that's kind of how I would use the information. I wouldn't use QLD or TQQQ or any of those things. Okay. I would instead use straight SPY. I don't even need triple Qs. I don't think that's the place to have money right now. So the way I think I'll be using the information that the algos on this desk give us is to trade 1-to-1 S&P, no leverage, 50% of the portfolio. So the process will be, we get a risk monitor, not even a risk monitor green. The first thing we'll get is the swing strategy for the S&P only. And I'll put half my portfolio to work in SPY. In a bull market, I would put all the portfolio to work and triple the S&P, right? So now I just half the portfolio to work in SPY. See if I can make some money. If I make some money, next time, a little bit larger. That's how I'm going to do it. Hang on a second, guys. Don't go away. Okay, I'm back. Questions? Richard, nobody unloaded puts into the weekend yet. And I'm on this last carry trade here. And, it's been a day where I've just been losing money carry trading. So let's be clear on that. But I'm on this last trade here and I'm up a little bit on it. And I'm trying to catch some type of a move here. It's 330. Does it walk up? But if it takes out this very tight stop in here, I'm going to book a profit. I'm going to book a profit today on a trade. I won't let that get away from me. But if it's going to go, I'm going to let it go a little bit. If you're off the desk and you're on here for the 3:30 update, don't forget to go to the Slack channel that we have set up for you, ARMR portfolio updates, and you can see what I've done. And I'll just give it to you off the top right here, Richard, in case you missed it. I've removed everything out of the portfolio with the exception of physical gold, AMLP, and AT&T. Everything else is gone. I took all that capital and I put all of it into treasury bills out till May. And I'm going to sleep on a bed of treasury bills over the weekend. I haven't the slightest idea what's going to happen over the weekend. 50-50, right? There could be some great announcements on Sunday. Japan, Taiwan, whomever, Vietnam, everyone's cutting deals with the president. Market gap up 3, 4, 5% on Monday morning. Totally possible. I just can't put money to work right now in this market. I'd rather hold 4.3% treasury bills. And at this point, I'm not doing anything until the ARMR algo for the S&P gives me a buy signal. That's it. So this is how I'm going to put capital back to work. Now, we had a week, let's be clear. We had a week where we lost some money on this desk. but like our alpha went like this because whatever we gave away this week wasn't even remotely close to what the market was doing. So we've had a really good week. Okay. Do I wish I'd stayed short? Of course. Of course. You know, I made money twice shorting, booked my profits to get out of the way of what I thought would be a rally on the news. And instead it was like the biggest 2-day decline since 2008. Okay. Sometimes that happens. All right. That decline, since it's so outside of the bell curve, and this is the part that I think is most concerning that I don't think a lot of people kind of calculate. When you get to the tail risk in a market like this, there are, without a doubt, some big funds that are caught flat-footed with a lot of leverage in something that they didn't think would be affected by the tariff thing. Okay, that's what's happened, and you won't find out about those cockroaches for the next couple of weeks. So there could be a huge rip back Monday, Tuesday of next week, and then a crater. Like I would be looking to short rallies, big rip back. Don't forget, market. I say this over and over again, but just forgive me. I'm going to say it again for anybody new who's listening. The biggest 2-day rallies happen in a bear market. The biggest 2-day rallies happen in a bear market. So at any moment, there could be a massive 2-day rally. It won't change my negative opinion. And quite frankly, I'll be looking on day 3, day 4, day 5 to get shorts out for the retest of the low. I don't think this type of market bottoms until it sets up a base. So you'll get the rip off the bottom, a test, and then a move. The risk monitor definitely won't go green on a V bottom. I can guarantee you that. So if the only thing that'll get me long on a V bottom will be the swing strategy for the S&P only, in which case, so let me go over what I'll be doing with the portfolio, right? I'm maxed out cash, couple token positions left, treasury bills, whatever hit I took this week, I'm done. So now how do I rebuild the portfolio? First layer is going to be S&P to harvest the alpha of being dramatically more defensive than the market, right? So, okay. So the first step will be to put an S&P position on. So when the S&P algo that we use gives us a risk on entry point, I'm going to have 50% of the flagship fund long SPY. I'm just straight S&P, no leverage. Let's just make some money on the S&P. Okay, we'll swing trade that. Then when that gets stopped out, we'll wait for the next entry. The second entry might be something that brings on all the indexes, and we'll have a risk monitor green, in which case 50% SPY again, and then maybe some new investment ideas off of my whiteboard. So we'll be working on the whiteboard here. We'll be doing all that, okay? So we're just simplifying everything now. It gets a lot easier. Just get rid of all the noise. Somebody DM'd me that they were excited to be able to buy a stock today that was on their list. And I don't want to get in your way. Go do what you want to do. But just to be clear, that is not the ARMR investing way. I got all kinds of things on my list. I don't buy a falling knife. I don't run out there and buy on days where the market's imploding. So when I talk about building a whiteboard, this is what I'm afraid of. You guys think that I build a whiteboard and let's go buy what's on the whiteboard. No, the whiteboard is to watch my favorite names. And a couple of them need to get away from me before I start putting money to work. You put your favorite names on there to see, does anything run away? When things start running away, okay, great, the market's changed. And believe me, there'll just be tons of ideas for us to start buying. It won't matter that one got away. So there's absolutely no buying right now on this trading desk, just to be clear, okay?
Order filled.
I'm booking some profits on this last trade here. Yeah, we got a trade on that made some money. Okay. So I just booked a little bit of profit right there, and this is a rally back. Honestly, the only move I was looking for here is a rally back to the VWAP. I don't think it's getting much higher than that. So I took a third off there. It's 338. I mean, this could do anything. There could be some big down bars here, or it could go bang, bang, bang. I have no idea. So I'm just letting out a little bit. I'll probably let out a little bit more at 345, and then, carry that last third to see where it takes me. So just to reiterate, slow down your investing process. Hold on to your capital. Take the first step in something that has, in things that aren't high beta, right? For me, it's going to be starting with the S&P index, get a position on, harvest some alpha. It starts working. I'll build up my whiteboard of the right chart patterns and the right fundamental companies, the right stories I want to own. And I want to see a couple skyrocket away from me. Okay. But this is going to be a layering in situation. First, we'll get a trade on the S&P. We'll see if we make money. It could be like 2008. We get an entry point, fails, get an entry point, fails. So we don't want a lot of capital to work. Get an entry point, put some capital in the S&P, no leverage. If it works, book a profit. When we get our stop hit, wait for the next setup. Now we have a double bottom or a higher low and bigger time in the consolidation to set that up. So now you have, instead of like a 1 week bounce, could be 4 to 8 week tight pattern, double bottom type of thing. And then we get a move in the risk monitor green. Then we get more aggressive. And I'm telling you right now on my desk, there will be nothing else I do. Nothing. I was willing to, before, preempt, try a little of this, try a little of that. Because that's where the market structure was. It was okay for me to do that. We were right around the 200-day moving average. So if it can hold there, makes a double bottom, I'll try. That's blown out of the water. We just had the 2 worst days we've had since 2008. And the biggest issue that people don't realize is that when you have that type of tail risk volatility, I guarantee there's a hedge fund somewhere blowing up. They have some exotic trade on. In 2008, it was credit default swaps and all this kind of stuff. They have an exotic trade on. In 2008, it was a whole bunch of mortgage-backed securities and ridiculous tranches of just junk that seeped its way into the money market fund market. Remember, you guys don't remember this, but the money market broke the buck because they owned a whole bunch of mortgages that were defunct. Okay. So what I'm saying is we don't even know right now who just blew up. But in order for the market to drop like that, somebody big is blowing up. And so what's happening is they're getting margin calls and they're just dumping everything to try to fix the problem they have. And honestly, the only thing that really stops that is a Fed that starts liquefying the market. And the Fed just said today, they can't liquefy the market. We got tariffs. We don't know what the tariffs are going to do.
Order filled.
We don't know what the tariffs are going to do, they said, right? I just took off a little bit more. I've booked half my gain now. And I'll just carry the rest. A little bit longer, but not much longer. Not much longer. I'm not greedy today. I just wanted to go into the weekend with a gain there because we knew that trade back to the VWAP was going to happen at some point. It's just happened, and now it seems to be fading. Anyway, just clawing back some. What was I just saying? I was saying, nah, I can't remember what I was saying, but I'll go to questions now. I got a question here from Andrew. He's going to work. Andrew Heyman, it's a pleasure working with you this week, Andrew. What do you got for me? Looks like I'm going to be grumbling about being in a bear market longer. Yeah, I know. Seriously, ever since you've been started with us, you've had to deal with 2020's collapse, and now you're dealing with this. And then 2022 was brutal. Absolutely, absolutely, Andrew. You're doing great. You know, you're really handling the situation well for a young man doing what you're doing. So, congratulations on that. Oh, thank you, Ivy. Thank you, Ivy League. Yes, that's what I was saying. So, what gets us out of these types of implosions is a Fed willing to liquefy. And what scares me right now is we're in the midst of an implosion with the Fed reducing liquidity. I started the morning meeting off this morning showing you that chart. All year, the Fed's been reducing their balance sheet, reducing liquidity. And they come out today and say, we can't cut rates. We don't know what tariffs are going to do. And it looks like, inflation's going up. That's a bottomless pit for the stock market. I mean, what has to happen for the Fed to change that opinion? Last I checked, the market was pricing in a rate cut on May 9th, the May 9th meeting. Is that going to happen? You see what I'm saying? So best to protect capital at all costs in here. And when we do try something, try it without leverage and without a lot of beta. Okay. Tech Monkey, hey, how you doing? It's been a long time since I've seen you. Thoughts on SCHD? SCHD, what is that? Oh, U.S. dividend equity. %4 yield. Deb, the problem right now, and this is just an equity, this is a dividend portfolio from Schwab. So this is true about all dividend stocks, right? The problem right now is that yield is now over 4%, but before it was less than 4%. And I can get 4.3% in a treasury bill without any risk. So what would compel me to buy that fund at a 4.11% yield with market risk when I could own treasury bills at 4.3 with no market risk? That's the biggest problem in the market right now. That's why Trump is saying to the Fed, please cut rates, because it's just sucking liquidity out of the system. So when you create uncertainty and the liquidity is out of the system, and I could do something like 4.3% with no risk, why would I buy this thing? Look, Deb, I didn't own this, but I did have a portfolio full of utilities, right? Utilities just broke down. And so what we did today is we booked our profit in Duke. We bought in the green box down here, and I just booked a profit today. I sold it. We bought Southern Company down here. I just sold it. Right? We bought AEP down here. I just sold it. And then we had a loss on Dominion. I bought that right in here. And we were making some money. And then today it took us back below break even. I sold it. Okay. I made a lot of money in Altria from down in here. I just booked a profit today. All right. We have Verizon. We've been trading Verizon. Bought it down here, went through the breakdown on whatever that company announcement was, but I sold it today, booked a profit. The dividend stocks are under attack today, like everything else. And that's what makes me very uncomfortable about the market. Okay. And so that's my thought. Okay. I gotta book the rest of this game.
Order filled.
All right, I made a little bit of money on that last trade there, but I'm out of Dodge and it's 347. And who knows? They could reverse it and blow it out again. But I'm not greedy. I'm not greedy right now. That was all I'm going to get on that trade. Pretty weak, but a gain nonetheless. I'll take it. So you hear what I'm saying, Deb? You see what I'm saying? It's we're in a liquidity vacuum. We've had two of the biggest down days that we've had. The last time it was this bad was 2008. I mean, what else do I have to say? You see what I'm saying? Just treasury bills. Don't worry about, am I going to miss upside right now? Right now, it's how do I protect my capital to live through this period? And there'll be more than enough time for us to rebuild. And we'll use the ARMR algos to do it. Look, I don't want to keep saying this, but I guess I do because it's fun for me. And I hope you guys, will allow me in all humility. The risk monitor went red here, right at the top of the market. Right at the top of the market. We're at risk monitor red. I mean, I still had some positions on because risk monitor red could be a sell-off to the 200-day, and then the market can recover. So I carried my dividend stocks. And then this week, really just the last 2 days, actually, yesterday they were up. So it's today they got blown out of the water and I'm out. And we've gone from what could have just been a correction to a full-blown bear market. And maybe I'm repeating myself, but only because I've been through these cycles before, and for some of you who are new and haven't been through it or you don't remember, the real danger is that somebody's blowing up right now that we don't know. There's some hedge fund, multiple hedge funds, some strategy that's blowing up right now. Like I know there's, I'm looking at VIX. I don't trade VIX, but I know there's a ton of guys as an example. Okay, here's a weak spot in the market. Here's a very dangerous weak spot in the market. There are a ton of guys, one of whom is a dad at one of the kids that's in my daughter's class. His dad and I hang out every now and then at functions at school, right? And he loves to tell me how much money he makes selling VIX. He loves to tell me. And he uses a lot of capital to do it. And he always tells me, yeah, there's a couple times where it goes big against me, but if I just wait, I put up more collateral. And I make it through it and I make a lot of money. There are so many people doing that, right? So many people doing that. And I know exactly what he would say to me right now. Brett, I had a god-awful week, put up more collateral, and I'll be okay. Until he's not. Until we have another Volmageddon. And then he can't afford the tuition to put his kid through school. I hope that doesn't happen. He's a wealthy guy, so I don't think he's going to blow himself out of the water completely. I'm sure tuition's covered. But you get my point. He's not a sophisticated vol investor. Somebody introduced him to this, and he's been selling vol now for a couple of years and making a killing on it. He's been making like 20% a year selling vol. But what happens is he gets locked into the fact that he's always safe. If he just makes it through, he'll always be safe. I almost want to say, can't you, what would you have done in, I think it was 2020, he wasn't selling vol. What would you have done? Like volatility went from like 20 to 150 and like, what was it? I don't know what it was, a couple weeks? Are you going to keep putting up collateral? That's just one example of what's out there. We don't know. There's other things out there that we don't know. And in my experience in markets like this, they're blowing up right now. And you won't find out about it for a couple of weeks. And the market will have a day or two where it rips and then it craters again. And it rips and it craters again. Because every time it rips, that guy who's blowing up is just doing everything he can to keep up with his margin calls until the whole thing washes out. And it usually doesn't wash out until the Fed adds liquidity. So almost to wrap up this discussion, I don't know, Chicago Dave, if you're still with me, but at this stage, I would submit to you that we're not going to have a real investable moment until the Fed comes out, cuts rates, and says they're adding liquidity. And it'll be at an awful time, worse than this. It'll be awful. The Fed will come out and say, we just cut rates 50, but it could be May. It could be May 9th. They could shock everybody. We've cut rates 50 basis points, and we're starting to do quantitative easing again. That'll be the time for us to start putting money to work. Like when that story comes out and our risk monitor goes green, we hit it with all guns blazing, and it won't be easy. But that will be the entry point, and it will be easier for you and I because we're not a bag holder. We got boatloads of cash. We've avoided 3/4 of the market collapse. Maybe even more than that. It depends on your portfolio. I mean, maybe we've avoided 85% of the market collapse. And we're sitting on tons of cash. And we'll get a risk monitor green the week the Fed says they're reducing interest rates 50 basis points and adding liquidity. And you and I will be putting money to work. While everybody else is like, blood in the streets, bag holding nightmares. And between now and then, the only thing I'll really be doing is trading the S&P, no leverage, to harvest alpha. That's the only thing I'll be doing on the desk. Yeah, absolutely. Ivy League just said, in his opinion, the chart speaks exactly what I'm saying. The Fed the market tried to find a bid in front of the Powell comments and then just fell out of bed afterwards. Yeah, that's it. Look at Philip Morris got hammered. This is a get out of Dodge moment, guys. This is just get out, get out. That's what it is. Ooh, I can't believe we made money on that trade, huh? Market just imploded to the close. All right, clawed back a little bit. Bitcoin and MicroStrategy are up today. Wow. Who wants to own MicroStrategy puts with me? Stephen, I got about a 5% position on Sprott Physical for, portfolios, the flagship fund. In the macro fund, it's 10%. I know that gets confusing sometimes, but so for flagship purposes, it's about 5%. And quite frankly, I wanted room to double it. I want to get it to 10 in the flagship, but in macro, it's 10. I couldn't help myself. I just bought some puts on MicroStrategy. We'll see. I couldn't help it. I couldn't help it. All right, guys, listen, this was a pleasure working with all of you. I hope you found the information helpful. As always, you got to make your own choices, risk tolerance goals, all that stuff. You got to be the smart money for yourself. I'm just sharing with you my experience, and I hope it helps. If you want to join us, you can go to the website, armrinvesting.com. There's 2 different ways to do it. You can access just our morning meeting. So every morning, 8:45, join us, get the captain's note, which is kind of my morning meeting notes, how we're going to day trade, how we're going to swing trade, what our targets are, all that stuff we cover at 8:45 morning meeting. And then, of course, you're on your own the rest of the day, or you can become an Armor Insider. Join us on the desk all day, like we did today, and trade with us and share information together and work together as a virtual hedge fund. Hope you all have a wonderful weekend. And really, thanks for spending the time with me. Take care, guys.